Mm. Hello, everyone. Very good evening to all of you. Please tell me my audibility and visibility. Is everything fine? Perfect? Can we start today's session, the marathon session, the final marathon session of module C and D? Tell me, is everything fine? Clear? Okay, let me also check. Okay, everything is fine. Okay, good evening, Krishan ji. Very good evening. So, yes. In yesterday's session, okay, we have did our first marathon part, and that was it consists of module A and module B. Okay, we have covered all the things related to module A and B that are very relevant for the examination point of view. Now, in today's session, okay, we will complete our rest of the modules, that is module C and module D. And among these two modules, the module C is very important. And which unit is very important? That is mergers, acquisition, amalgamation. So this is the unit which is very important. Clear? So yes, let's start with the marathon session. Okay, so let's start with the marathon session of module C. Now, so if you have read all the modules A, B, C, D in the yesterday's class also. So you have seen in the module A that how we can manage our organization, how we can manage our business. Okay, this is what we have studied in our first module, that is module A. Now, in the second module, what we have studied, okay, we know how to manage our organization. Now the second part comes to how to manage the finance, how the business organization will occur its activities. Okay, how will what actions they will going to take in order to procure the funds. All these things we have to study in module B, and this what we have did yesterday. Now in module C, okay, we have arranged the finance also, we have arranged our human elements also. Now in next part, what is the main element is that we have made a huge earnings also. So from this earnings, now what is the third part is that where to invest such earnings. Okay, we have made a lot of earning, a lot of profit. Now the time comes to do a investment. Also for the investment purpose, what we need to do, if we are investing on any project, or we are acquiring any business, or we are merging any kind of business, we are taking a control of any kind of business organization, a company. So what we need to do is we need to do the valuation of that company. I'm not going to purchase like this only. A proper valuation should be made, should be done in order to know its real price, real worth, real value of that company. So for this, we are doing the corporate valuation. The corporate valuation is the very first step if we need to value a company, if we need to take out what is the actual valuation of that company. Clear? Done. So, what is corporate valuation? It refers to the process of finding all economic value of a company of or business entity. So, it can be expressed in monetary terms because we are taking out the value, and value we know it is expressed in terms of money in monetary terms. So, this valuation is very common and it is used in various purposes. It is used in mergers and acquisition also, for investment analysis, for financial reporting, and for the strategic planning, the planning which we do for our organization to reach, to achieve all our goals. Now, so corporate valuation, it is the process, and there are two types of value. So if we want to do the valuation, what kind of value we are taking? Okay, we are taking on a book value, or we are taking it on a market value. So the International Values Assets Valuation Standard Committee, it is responsible for making the International Valuation Standard. For developing this IVS, the International Value Standard Committee is responsible. And this is very important. Now let's understand the book value. Book value means what? The value which is mentioned in your books of account. The original purchase price of a particular asset, of a particular machinery, of a particular vehicle, anything. Okay, so that is the book value. And market value is what? Market value, that is the current value which is prevailing in the market of that particular asset. That is market value. Clear? Now, what are there are different approaches, there are different models to do corporate valuation. So first is income-based approach. So income-based approach, see from the name itself, it is clear income-based means it focuses on the company, how much it can generate income. Okay, ability to generate all the future cash flows. So future cash flows means what? That is, we have to do the discounting method. So income approach is also known as the capitalization approach, very important. So this approach helps us to generate all our future cash flows, and it also estimates a company or investment property, what is its actual value, what its expected future income. In the future, what the income will be generated from that particular property. Now, discounted cash flow analysis. So discounted means what? You need to do the discounting. We have read in our module B how discounting is the discounting factor element is given to you. Okay, like 12%, 14%. This we have done in IRR method, NPV method. So discounting after finding the future oriented cash flows, we do discounting. So using net income approach, that net operating income approach, which is used in such income based approach. Now market based approach, that is in market what is the current price prevailing of particular company, of particular business organization. So market based approach, it determines a company's value by comparing it to any other similar company. Okay, suppose I can't find the value of this particular company A. Now I will find the company which is similar to A company. Suppose B company is similar to A company, all its activities, all its process, all its structure, everything is similar. If I can find the value of this company, then I can easily take the value of this company as well. As why? Because both companies are working in the same scenario. So if the value of this company is 10 crore, then the value of this company will also be 10 crore. So the comparison method is used, okay, in market based approach. Now cost we use all asset based approach, okay, in for the for calculating the value of with the help of cost approach. Okay, the cost value is based on the value of its assets, and we will deduct from those assets the value of the liabilities which we have to pay off. Clear? So this is asset based approach. So this method is most commonly for companies that is having a lot of physical assets, means those tangible assets which we can touch and see them, or when a company is in any kind of trouble. So this asset based value is very important in case of liquidation as well. As now, adjusted book value. Okay, what is adjusted book value? Can anybody tell me? See, what happens sometimes the amount which is mentioned in the book value, okay, it does not generate a proper value. So adjusted means what? Something modification has been done in that book value. Clear? So it is a refined version of the basic asset-based approach for valuing a company, while the basic asset-based method, it uses book value. So it might not generate the appropriate, you can say, the valuation. So that is why the value reflects a more accurate and current market value of its liabilities. So we need to do adjusted book value. In the adjusted book value approach, the value of the company, assets and liabilities is adjusted to reflect their current or market value. Okay, you can't just rely on the historical data, on the traditional accounting values which is being written in the balance sheet. So these may be outdated, these may be obsolete. So in order to adjust it, in order to do a proper modification, we use adjusted book value so that a proper valuation can be determined. Tell me, any doubt, anyone? So this is a particular chart. Okay, if you will see, the liabilities and assets are over there, and the what is investors claim among these all the following liabilities and assets. So the investor will first of all take all the share capital, okay, the reserves and surplus, the loans which are secured means you have given a security, a mortgage on taking such kind of loans. Okay, term loans will not be included because the security which has been given on loans and the loans which have are not being secured. So these two loans the investor will take. We do the total, that is 97. It comes in crore. The value is in crore. Now, from the asset sides, all the total assets, okay, what is the total assets? 1116. And from the total assets, 1116.40, if we will deduct the liabilities, what were the liabilities? Okay, all the rest of the, you can see over here, these are the liabilities. If you will deduct this, like current liabilities and provision, it comes 19.40. So 19.40. If you will deduct this, so you will get the investor's claim approach, the same value which is written over here. Okay, that is 97 crores. So we need to deduct the current liabilities from our all the assets. Clear? This is what we have studied over here. Things the company owns and subtracting its all of the liabilities. Now, stock and debt approach. Again, it is a type of a financial management concept. Okay, it determines all the operations of the finances. Okay, how they are being financed on different projects, on different companies, their growth, their net operating income, their net income. Okay, so it focuses on the ways a business will raise fund with the help of debt, also with the help of equity also. So this is with the help of debt and equity. If we use these two approaches, okay, in terms of calculating the valuation of the company, so it is termed as stock and debt approach. Now, direct comparison, again, direct comparison means one company is there. If you are directly, if you don't know the value of this company, the similar type of company will be there. Okay, you have to find the similar type of company, and whatever the value of this company is, the same value you can put on this company. So this is direct, you are comparing. Clear? Which states that buyer will not pay more for a given property than the cost of a comparable. If this company costs rupees 10 crore, and if you want to purchase this company, okay, so you are being talking to the owner of this company. The owner says, no, I will sell this company in 15 crore. Okay, let's take an example, 10 crore. So you will say, no, I have compared the value of your company with the another company. The value of another company is 10 crore. Then why would I will give you 5 crore more? I'm going to purchase this company on the value of this 10 crore only. So that is written over here, that a buyer will not pay more for a given property. Clear? It is basically a market based approach where the value of an asset is determined what comparing to similar kind of assets. What is principle? If you have seen this, there is a it is founded on the principles of substitution. It is just like same means, if I'm getting the value in 10 crore, so why I'm going to pay 5 crore more, 15. So this is principle of substitution. Clear? Means you are substituting any other assets. A buyer will generally choose a cheaper alternative that meets their need if it is available. For example, a buyer might not pay, okay, 1 crore for a house if they can buy a similar house in the same area for rupees 75 lakh. So why would the buyer give 20 lakh more? No, if he is getting in 75 lakhs. So this is principle of substitution. Clear? Now, what are the steps involved in DCA, direct comparison approach? Okay. So first of all, you have to define the nature of the asset. Okay. What type of asset you need to do the valuation. Then you will compare that. After comparing, you will gather all the information related to that comparison. Then you will analyze. You will calculate the adjusted value. After calculating, you will interpret the result. Okay. I'm getting this much value of this company. If the other one agrees, you will document the process. You will record all the adjustment, that methodology which is used in the valuation, and after that you will prepare a final report. Clear? Now, so this is discounted cash flow approach. Again, it is a financial valuation method that used to determine the value of an asset based on its expected future cash flows. future cash flows. And this is what? This is discounting. Clear? So CF upon 1 plus R minus. So discounting uh, cash flow you can find in this way. And I have solved one question also in case study of module C. If you have seen my marathon of module C, you have seen that on the basis of this I have put one question related to case study, and there we have solved this such type of questions. So steps involved in now valuation using DCF approach, discounting. First of all, analyze the historical performance. Okay, the invested capital, how much capital has been invested. Okay, what is the operating profit? What is the ROI? What is the net investment? So you need to do, find out all the traditional or historical data. Okay, then you will use calculate free cash flow by using all the steps, by using all this you can say methods. Then in the third step, what you will do, you will find the WAC, weighted average cost of capital. Okay, you will find this weighted average cost of capital. Then based on the calculation of step 2, okay, you will forecast all the future cash flows for an explicit fund, that is forecast period. Okay, you need to find the cash flows using with this weighted average cost of capital. After finding all the value, what you will do, you will find the present value factor. If you will find the present value factor, then you have to what, add all the values that come in this step and that comes in this step, okay, to find the actual value of the firm. So no practical questions they will ask. They will just ask which step will come first. Okay. Now, discounted cash flow. So what are the approaches to discounted cash flow model? See, in few chapters we will be learning discounted cash flow, and one chapter is there where we will be seeing non-discounted cash flow. Now, what are the methods we can make the calculation, we can make the valuation of the firm without discounting? Here we are learning the discounting methods, and then later on it will come of non-discounting. Clear? So there are basically three approaches. First, you have to ask with yourself. Your first approach is it possible to estimate cash flows? Is it possible to justify? Is it possible to find out all the cash flows? Okay. If the answer is yes, then you will see the type of leverage. Okay. If the answer is no, then you will use dividend discount model. Clear? If you're not unable to find the cash flows, then you will use simply the dividend model, because ultimately you have to distribute the profit to your shareholders. So you will use dividend more discount model, or you can say the Gordon model. Clear? Now, type of leverage, is this static or dynamic? If it is static, means if this is stable, okay, then you will use free cash flow to equity. To equity, if this is dynamic, means uncertain, okay, then we will use free cash flow to firm, because we don't know, we are not certain, we are very uncertain. So we will take the help of the cash flows to the firm. And here free cash flow is using to the equity. Now, approach two. We will first look our current earnings. What is the current earnings of the particular company which we want to do the valuation? Is the current earnings positive and normal? Is the current earnings is abnormal, means making continuously losses or not incurring profits, okay, or a break even point? So use current earning base. If it is abnormal or negative, use current earnings. If then you will see, do you have any current earnings right now? If yes, you will use normalized earning in place of current earnings. Okay, the normalized one. If no, if you don't have your current earnings, you will you will again ask, okay, is the survival possible in this form? If answer is yes, you will use margin adjustment needed. Okay, so these are all very important. If no, then you will again ask, okay, if earnings is not possible, then is your company over debt? Means is your company has a very much high interest, high burden of interest in your company? If yes, then value equity as an option to liquidate. The option is only to liquidate the company. If no, then estimate the liquidation value. The what the value comes after liquidating that company. Clear? So this was approach two. Now, again, the third, present growth rate. Now, you will see the factor of that company. What is the growth rate? At present, what is the growth rate of that company? If less than the economy's growth rate, means the growth rate which is prevailing in the economy. If it is less than that, use stable growth model. If it is more than that, then you will ask, is there any competitive advantage? Means it is competing the competitors or not, that company. If yes, use two-stage model. If no, then use three-stage model. Okay. So these are three approaches where you can see, you can find, you can calculate the exact valuation of that company. So various discounted cash flow models. The first is enterprise discounted cash flow model. Okay. So this model applies what, a discount factor, a discount rate, which should be equal to all the weighted average cost of capital, that is WACC, cost of equity, cost of debt. Now, enterprise equity DCF, so it will include only the equity. Okay, so the equity discounted cash flow model can be implemented in further two ways. The dividend discount model, okay, that is what, that is KE, the dividend discount model. The, you can say the Gordon model. Okay, so D1, what was the formula? Can anybody tell me? Can anybody tell me the formula? Now, the dividend discount model takes into account the cost of equity, D1 plus P upon G, growth rate. Clear? The free cash flow to equity model also takes into the account of cost of equity. Clear? Tell me. D1 upon KE minus G. And if suppose in the question previous year dividend is given, DO is given. So how we will find the present year dividend? Can anybody tell me? That is DO 1 plus growth. Okay. So this is the formula of finding the current year dividend if in the question the previous year dividend is given to you. So they will write that the previous year dividend is this. Clear? Now, dividend discount model. This is the formula which I have written. D1 R minus G, or R is what? Weighted average. Oh, sorry. R is what? This is the here which we have studied, the KE. R is also said as KE. Clear? The return which you will get, the minimum required rate of return, KE or R, the minimum required rate of return. Okay, so this is the formula of dividend discount model, which is also known as Gordon growth model. So that is why growth G stands for growth. Okay, D1 stands for present year dividend. See this, the present year dividend. Okay, D1, current stock price, that is P, the value of the stock which is at today, growth of the dividend, and R or KE stands for that required rate of return. Okay, it is written as R also. If in the question R is not there, then they will give you as KE. Clear? Yeah. Now, the next unit is non-DCF. Okay, if we want to make the valuation of the company, okay, all these things we have done, that we will use the discounting methods. After discounting, how we will do the valuation of that corporate sector or that company. Now, if we want to do the valuation of any company without considering the discounting factor, without considering discounting cash flow, we are using non-discounting cash flow model. Clear? So valuation methods, they are broadly divided into two groups, the DCF, this we have seen, and the non-DCF. So in this particular unit, we will discuss the valuation models which use non-DCF methods for valuation. And what are the models? The first is a relative valuation model, equity valuation. multiples model, enterprise value multiples model, book value approach, that is the which is mentioned in your books of account, the balance sheet, the value of the assets, and stock and debt approach model. This also we have seen. Now, relative valuation model is what? See, again, all the relative valuation model is just like a similar model. Okay, a similar valuation means if I want to purchase any company and I can't find the value, appropriate value of this company, I will look another companies. The parallelly, I will look many different companies. Okay, so I have found 3, 4 companies. Now I will find the valuation of these 4 companies. Okay, all these companies are working in the same manner. This is this one, this one, this one, this one. If every company gets, let's say, the value of rupees 20 crore, so I can also value this company as 20 crore because everything is same. Clear? So, for instance, when selling agricultural land, you could use the price of a comparable property. Okay, because you don't know the actual value of that property. So, what method you will do? You will use the relative valuation method. You will use the comparison method. You will use the similar method. All these three names are synonyms of relative. So this model value a business or asset by comparing it to similar businesses. So if we compare with any similar type of business, and if we know the value of that similar business, we can also put the value of the business which we want to purchase. Clear? If I'm not able to find the value of the company which I'm going to purchase, I will find another company's compare as similar to that company which I want to purchase, and whatever value comes to the other company, I will put that I will generate that same value to the company which I want to purchase. This is comparison method. Okay, the relative valuation method, and these are having different multiples. Okay, the companies operating in the same industry in the same sector, they will also have the same multiples. Okay, the PE ratio, profit earning ratio, profit to sales ratio. Okay, enterprise value and EBITDA, all every multiple will be same. So if a 2-acre plot recently sold for rupees 10 lakh, that is 5 lakh per acre, so you would value your 5-acre plot at rupees 25 lakhs. Clear? Suppose it is example is given that if a 2-acre plot recently sold for rupees 10 lakh, means if 2-acre plot sold for 10 lakh, okay, in your area, it means 1 acre plot was sold for how much rupees? 5 lakh rupees. And if you're having a 5-acre plot together, so how much will be the value? If you will do 5 into 5, that will comes how much? 25 lakhs. It means the value of your 5-acre plot is how much? In today's time, that is 25 lakhs. This is the relative valuation model. Now, what are the steps involved in this relative valuation? First of all, we conduct the research. Okay. After doing proper research, after exploring things, we will see that my business and the other business, are they both are same? They both are working in the same manner. Identify businesses that are analogous. Analogous means similar, same. Okay. Then if the business is same, then I have told you that the multiples will also used in the valuation. They will be same. Now determine the multiples. Okay. Figure the valuation of that multiples, and then finally establish a proper value of that concerned business, of that business which you want to make the valuation, which you want to do the valuation. Clear? So conducting research on the concerned organization. Okay. So there are following factors that will definitely create an impact of the company's valuation. First of all, the market sectors, the range of products that are offered by the company and various market, availability and pricing of the input. Okay. Now, how much raw material we can access? Okay. How much resources are needed for the production? Are they giving us the best result? Are they creating a positive impact? Now, Technological potential and manufacturing capacity, the company's ability to innovate or scale its production. If everything is good, okay, then we can make the valuation. If we find any fault in that particular company, so we will look for another company. What is the market reputation of this? Okay, are the customers loyal? Okay, are they able to retain their customers in the market? What is the position there? The distribution channel is how much wealthy, the loyalty of customer, and the differences of the product and competitive position. Means how your product is different from the competitor's product. Suppose you have also launched the same type of product one, and the other person, the your competitor, he is also launching the same kind of product. Okay, this is A company, this is B company. Now, what is the different feature in your product that will differentiate your product from the competitor's product? That uniqueness. Okay, so the uniqueness of the company's product and its standing in comparison in terms of quality. Your quality is superior or inferior. Okay, how much price you have put for your product, what is the demand for your product in the market. All these things are necessary, okay, conducting the research for that particular concerned organization which we want to make a value. Then the human resource we will check. Okay, we will also use see the caliber of the workforce. Are my workforce caliber enough to you can say to overcome any kind of challenges. The market dynamics, because it is not certain, it is very uncertain. And access to your capital, the leverage, how much borrowed capital you have taken in your company. Market liquidity is, it means you have your reserves or not. Do you have your cash reserves or not? So that if required for expansion and growth, those reserves can be easily liquid in the cash. Now, determining the multiples used in valuation. So, what are the multiples? The first is price earning ratio. This we have seen, the book ratio, price sales ratio, EBITDA, okay, EV sales. Now, figuring out the valuation multiples for the other comparable companies. So, two companies are given, different company. One is company A and the other one is company B. Now, with the help of these multiples, okay, different multiples are given, EBITDA given, then book value is given, enterprise value is given. Now we have to find, okay, there are two similar kinds of business. The multiples will be also same. So we have to find the actual valuation of the company with the help of these multiples. So can you tell me what should be the actual value? So valuation multiples of the company are company A sales given 6,000, EBITDA given 1,000, book value of assets 4,000 and 3,000 it's. So now company A, how to find the value? That is enterprise value upon means yes, EBITDA. So enterprise value is how much? 3,000 upon 1,000. How much is the value coming? 3. EV upon EV and book value. Enterprise value is how much? Again 3,000. Book value is given how much? 4,000. So if you will do the division, you will get this answer. Then enterprise value and sales. So what is the enterprise value of company A? 3,000 and sales are 6,000. So 0.5. In the similar manner, if you will do this, enterprise value is given how much? 4,500. Upon what is the value of EBITDA in company B? 2,000. So this is the value. Then 4,000 upon book value is how much? 6,000. 4,500 upon what is the sales? 9,000. So this is the value. Now, how average can be calculated? Average simply means opening plus closing divided by 2. It means 3 plus 2.25 divided by 2. This value will come. Then, how much? 0.75 plus 0.75 divided by 2. This value will come. 0.5 plus 0.5 divided by 2. This value will come. Clear? So this is how you can find all the multiples given in the question. If they will ask the question, so such type of question they will ask in the exam. Okay, so this is how we can find the value, we can find the average of company A and company B if their multiples are valuation multiples are given in the question. Clear? So if the relative valuation, if we are using, so multiples will also be same. Okay, because if the company is having the similar features, their multiples will also be similar. Okay, I'm turning off the camera now. It is more visible to you. This is 2 divided by 2. Okay, let's move now. Now equity valuation multiples model. So equity valuation multiples model, we have P, price to earning, that is price to earnings multiple. Okay, then price to book value. P is price, B stands for book value. Then sales, relative PE ratio of both of the companies together. So relative PE is current PE ratio firm upon current PE ratio market. Here, so what is the PE ratio? So PE ratio defines, it is the ratio of, that is market price per share upon EPS. Okay, this is the formula. Only the formula is very important. Market price per share upon EPS. What is price to book ratio? Market price per share of book value upon value per share. Okay, market price per share book value per share. So this represents the book PB ratio, that is price to book ratio. Clear? Where market price per share is current market price of a single shares of a company stock, and book value is the net asset value of the company per share. So book value per share is how much? Total assets minus total liabilities upon the shares which have been outstanding, which has been get to price to sales ratio is what? It is market price per share upon revenue per share. Price to sales. So what is the price? That is market price per share, and revenue per share, that is sales. Now, enterprise value multiples model. So what is enterprise value multiples model? It represents the value of the enterprise. And value of the enterprise includes what? It includes our assets, our liabilities, our balance sheet, the whole of the balance sheet. It means it includes both equity and debt, the entire capital structure. Capital structure is what? Can anybody tell me what is capital structure? Come on, tell me what is capital structure. So capital structure is the composition of capital structure is the composition of two elements. And what are those two elements? The first one is debt, the second one is equity. Clear? So it includes both equity and debt, the entire capital structure, to find the enterprise value, to find the value of the equity and debt. Yes. So this is important. The formula of enterprise value, that is market value of equity and debt. And if you have any cash, okay, cash or cash equivalent, so they will be deducted from equity and debt. Suppose you have a equity of, let's say, uh, 10 lakh rupees. Okay, debt is how much? 5 lakh rupees, and your cash was 3 lakh. So 10 plus 5 minus 3, 15 minus 3. So actual enterprise value will come how much? That is 12 lakh rupees. Clear? Now, multiples model. We have seen na? Price to earning ratio multiples, then EBITDA multiple, enterprise value, sales multiples. So what are these multiples? A multiples model is type of valuation approach. It is used in the valuation, okay, that uses the ratios to compare similar companies and determine their value. The companies which are similar in nature, okay, the similar in nature, so their valuation is need to be find out with the help of the ratios, with the help of the ratios that is used in comparison of these two companies. Now, stock and debt approach. This we have seen in the previous also slides also. So, stock and debt approach. It is also known as based approach. A straightforward method for determining the value of the company. Okay, the company's stock, the equities, and the debt. That is the composition of debt as well as what equity. Stocks are what? They are just equities. Okay, company can be estimated by the with the help of this value. And what are the key components of stock and debt approach? The market value should be, you need to find out the market value of the equity, what is the prevailing market value, what is the prevailing market value of the debt, and composition of these two will give you what total value of the company, that is enterprise value. Clear? Just now we have seen this. The total value of the company is determined by adding the value of its equity or the value of and the value of its debt. So both are combined together to form the total firm value. Now, so this is one illustration or this is one example, okay, of stock and debt approach. So let's consider BML Limited. It is a name of a company. Its shares outstanding are 25 crore. MPS is given how much? 120 crore. Okay. Now, market value of equity is how much? The 25 crore. Okay. And the price per share is how much? 120. So, market value of equity will 3000 crore because it is given the value per share. And we have how many shares? We have 25 crore shares. So, the value comes 3000 crore. Market value of debt, it is given directly, that is 1100 crore. Now, total value of the firm, how can you find out? That is 3000 plus how much? 1100. So, 4100 crore. This is the total value of the firm, total value of the BML Limited as of March 31st, 2022. Clear? Okay. Now, next unit comes of what? The intangibles and yes, intangibles. Tell me, any doubt, anyone till now what we have done? We have seen corporate valuation, we have seen discounted cash flow valuation, we have seen other non-discounted cash flow valuation. We have completed our three topics. The fourth topic is what? Special cases of valuation. Can we move forward? And please, everybody, like the session, share it with others as well as subscribe the channel. Share it. Okay. We have seen the how to value the firm. Okay, we have seen discounting factor also. We have seen without discounting, if we do not consider the discounting factor, how we will do the valuation of the particular company. Now there are such companies. These are known as special type of companies. Okay, special cases of valuation. So what are such type of companies? The companies which are of intangible nature. So how we will do the valuation of such companies? Those companies which we, the intangible assets which we can't see them, okay, we can't touch them. So how those assets may be valued? How we will do the valuation of such type of assets, such type of companies? So intangible assets, it is of the special case, that is the special case of related to intangible assets. So in intangible, what it includes? It includes the goodwill, the reputation, okay, any kind of patent, any kind of trademark, the knowledge, the brands, okay, the tag brands, or the business processes, okay. So these are what intangible assets: the patents, copyright, any franchisees, the data of the customer, any kind of software, the trademark, the brand logo, goodwill, and the brand. So these comes under what? Intangible assets. And intangible assets are those assets which we can't see them and touch them. Yeah. Then now, what are the approaches for valuation? The first is capital investment. So capital investment is what? It refers to the total amount of money a company has spent on its asset on the on full overtime. Means whatever value they have spent on their particular assets, okay, for the full of their lifetime. So that is capital investment. Okay, capital investment means what? A long term investment. Because if you're purchasing any kind of asset, any kind of machinery, so you need to make that long term investment. Clear? So approaches for valuation is capital investment. But here we are talking about what? We are talking about the intangible assets. So we are estimating the value for any kind of brand, okay? Any kind of what advertisement we have made for that brand, okay? The market recognition, the patent, the copyright, franchisee. So these are also capital investment. Now, discounted cash flow valuation, okay, this we have seen, and relative valuation, that is the comparison method. Now, for real estate firms, we will do discounted cash flow valuation. First, we will estimate the discount rate. Okay, the discount rate in this we've looked at how to measure key factors like the risk, and a risk is denoted by what? The beta. Beta is the symbol which is denoted what? Which denotes the risk and the risk premium. Okay, cost of equity. Cost of equity, we for the cost of equity we take weighted average cost of capital. Okay, that is with the help of arbitrage method also, where simultaneously we are purchasing and we are selling. So the difference of the price is what? Our profit in arbitrage pricing model, and the CAPM model, which will tell you the risk of the beta. Clear? RM minus RF. This is the formula of what? CAPM, that is capital asset pricing model. Clear? And then we will ask that, are the marginal investors, the investors who are investing in such kind of properties, in such kind of real estate business, are they well diversified? Means their risk can be distributed, their risk maybe can be scattered or not. Clear? So these are the various things we will do discounting cash flow in case of real estate firms or property firms. Now, in case of startup, okay, what are the things that we need to take into consideration? First of all, we will assess the what is the current price of that startup. Okay, the startup is very new. So, what is the current standing? What is the position of that particular new startup? After that, we will see the growth rate. Okay, we will see the revenue growth estimation. We will estimate its growth in terms of revenue. If everything is fine, we will say if the company is at stable position, how much the company can make the growth. Okay, so those stable growth associated operating margin estimation. We will estimate if the company is working at the stability. It is in a stable form, then how much growth that company can make. Okay, a new startup can make. Then the step four is to what estimate the reinvestment to generate growth. If the company is no new and still company has made a lot of profit, so now we will estimate that the profit which that company has made, the, the company has earned a lot of profit. So is this profit can be reinvested on another new type of firm, on another new type of projects, so to generate more and more growth. So we will estimate that also. And for this, there is a formula. Expected growth, you are finding the expected growth, the reinvestment rate, at which rate you are going to reinvest into return on capital, expected reinvestment rates, all the rates will be given to you. So you will going to find the expected growth rate. So this is the formula. Reinvestment rate into return on capital expected reinvestment rate. Clear? After finding this expected growth, you will see what is the risk. What risk may come in the future. Okay. And in order to minimize those risks, okay, you need to find the discounting rate. How you will do the discounting of that particular firm. After that, the valuation of the firm regarding non-operating assets, and then also do you will estimate the equity value per share value, the equity value and per share value means the value per share is how much in the market. You will estimate that, and then accordingly you will see, you will make the valuation of that particular. So these are the 7 steps you need to keep in mind. Clear? Tell me. Can I move forward now? Now, now you have to make the valuation of such firms who which type the firms which are giving a very negative growth or their earnings are very low. Okay, those firms which are giving you a negative growth or their earnings are very low. How you will going to value such kind of firms? So value loss making firms, when a company has a negative earnings, the reason behind these losses will guide how we value the business. Okay, what the reason behind those losses will tell us that how can we value that particular company. So they have a poor profit history. So these poor profit history are discussed. So let's see. We will see how company facing momentary challenges. Okay, what are the concerns unique to the company? What are the issues they are facing? Okay, what are the concerns they are facing? The unique concerns of the company. Then the industry wide or market driven issues, the issues related to the market issues, the issues which are related to other industries. Okay, then companies with long term issues, company itself is also having different kinds of issues, so we will going to look that also. Then strategic issues. Okay, in the paid classes I have given the case study. Okay, I have showed you the case study how Kodak and IM, that is International Business Machines, they both have, okay, lost their existence. They both have what their company has been made. They are earning a good profit, but due to some mistake, due to the unplanned, the strategy planning is not done properly. So due to this issue, how this company failed. The Kodak company, okay, the camera making company, you have heard this word Kodak and IBM. Next is the operating issues. Operating means for day-to-day operations, we need fund. For day-to-day business operations, we need funds. So for this, okay, what are the issues that has been arrived? Then the size of the company. If the size of the company is too large, but you don't have enough funds to survive that company. or if the size of the company is too small, you're not doing anything to make this company big. So company size also matters. So this is also one of the reason which make your company loss. Aspect of the inefficiency. Inefficiency means not working properly. Okay, inefficiency means not working in a proper manner, in a smooth manner. If the members, if the you can say the people who are working in the organization in that firm, if they are not motivated, if they are not being rewarded, okay, if they have been given every time task, the rules are very stringent, so definitely they will not showcase their his or her skills in a very good manner, so the efficiency will there. So the efficiency also leads to the loss of the firm. The external limitation. So what are the external limitations? Can anybody tell me? Can anybody tell me the external limitations? What includes and what are the things that are included under external limitations? For a company, what are the external factors? Okay, tell me. For a company, what are the external factors? Anybody knows? We have seen in our very first marathon or in yesterday's marathon in our first module, the pestle. So what is pestle? These are the external factors. Are these or not? Tell me. These are the external factors. You need to analyze them very well. You need to take care. Those may not affect in your company. Those may not give a negative impact in your company. You need to analyze those. So these are also the external factors that may create a loss to your the quality of the management. And yes, if the management quality is good, the management is working good, definitely the people under those management, under those company will perform well. If the management is not good, then how they are expecting their members to be good? No. So there are 10 factors. Okay, so these are the uh, pro- factors that will tell a poor profit history. Okay, how the company may get into a loss and how value loss in firms, okay, they need to uh, go from all these situations. Clear? So this is why the companies earning a huge loss. Okay, they have a negative earnings. So behind these losses, these are the factors responsible. Clear this chart? Clear this slide? Okay. No. So there are also some financial service companies. Okay, those companies who provide the financial services like bank, NBFCs. So financial services companies these are firms that provide a wide range of services related to your treasury management, related to your financial activities, related to your money management, credit management. Okay, and they also play a key role in what in managing and investing, protecting the financial assets. Okay, there are two types of asset. One is physical assets, and other one is financial assets. Tell me what comes under physical assets and what comes under financial assets. Come on, quick, tell me. I'm waiting. Come on, tell me what comes under financial assets and what comes under physical assets. Okay, give me one example only. Physical assets are those assets which we can touch them. Okay, we can see them, like you can see a plant machinery. Okay, chair, laptop, computer. So these are your what physical assets. What are your financial assets like stocks? Okay, shares. So bonds. These are your what certificate of deposits. These are what your financial assets. Clear? So they also company play a key role in managing, investing, transferring, and protecting the financial assets for individuals also, for business unit also, and for the government as well as. So they operate in various sectors. They offer offerings from all the traditional markets. So there are some types of financial services. The one you know very well because you all are working in such category. Okay, in this sector, that is bank. So retail bank, they offer services like checking accounts, the savings account, the collateral services, personal loans to individual. Commercial bank, okay, they provide loans, they manage the cash, okay, they provide services to different business, they provide money to the public, normal public also. Investment bank, such banks who deal only in the category of investment. Okay, like if anybody wants to acquire any different company. Okay, suppose there is one person, okay, he wants to purchase this company, let's say company one. But the value of this company is, let's say, 50, not 50, just a minute. Okay, the value of this company is, let's say, 2 crore. But this person, okay, this person is only having 1 lakh 75 crore, 1.75 crore. Now, rest of the 0.25, okay, crore, he needs to manage that also. Then only he can purchase this company, he or she. So, what he will do, the acquirer who wants to acquire any company, and this company becomes what? The target company. So in such case, what happens? He or she will go to the financial sector, the financial company. Okay, he will ask loan from such companies that the company will provide him loan. So investment banks are those banks, okay, who provide these kind of services. Yes, Madhubalaji, furniture, very good. Okay, these are the physical assets. Correct. Very nicely. Okay. Now, so mergers and acquisition, corporate financing, investment advisory, underwriting, commission, security. So all these functions are provided by the investment banks. Clear? Now, there are insurance companies also who helps, this company provides the solution how to manage your risk, because there are different types of risk. Okay, you can say the credit risk, the liquidity risk, the market risk, the operational risk, many different kind of risk. So they help in providing the risk management solution. Okay, they will also help in providing the life insurance, then different types of insurance, property, other types of coverage as well as. Okay, so they also offer investment products like annuities, the pension plans, asset management and investment firms. Okay. So asset managers, what they do, they manage investments on behalf of any other client, any other customer. Okay. So these are different investors also, because they don't have enough time to manage their assets. They don't have enough time to manage their firms. So they do a type of BPO, business process outsourcing. Okay. They take the help of the third party, and that third party will manage their investment. Brokerage funds, these firms facilitate the buying and selling of securities like like stocks, bond, and other kind of financial instrument for their clients. They also offer wealth management, retirement planning services. These brokerage firms. Credit card companies, okay, they will provide you the payment solution, the credit card opportunities, okay, so that you can do the expenses and later on you can pay. The private equity and venture capital firms. This we will be learning in our next module, that is D. Fintech company. Okay, the fintech means what? The financial technology. Financial plus technology. Okay, they provide digital financing solutions for payment. Okay, for remittance facility. Mortgage companies, they offer home loans with the help of security, the secured loans to business and departments and different individuals also. So financial service companies are what? They include use of debt for earning their income. Okay, these are heavily regulated sector. These are regulated by who? RBI. They have difficulty in measuring the reinvestment. You can't do the reinvestment again and again in such companies. They have their own norms. They have their own regulation. They are being regulated by the RBI, the authority, the regulatory authority. They have capital adequacy norms, means a minimum amount of capital they are having. Okay, the adequate capital should be there in every bank, so that if any kind of financial crisis arises in the country, so they can take the help of that adequate capital. So the norms related to these adequate capital has to be followed. Then issues faced by the NPA. The biggest situation is the NPA, non-performing assets. So we need to reduce it, and we need to make non-performing assets, means the assets they should perform well. Here, what is asset based valuation? Tell me, till here it is clear to you? Asset based valuation, see, from the name itself it is clear. Asset based valuation means this valuation determines company's value by what? By calculating total value of assets minus whatever liabilities they have to pay off. Those liabilities will be deducted, then the accurate value will come. Okay, suppose your assets worth rupees 50 lakh rupees. So not, this is not the actual value of the firm. Why? Because you have to pay liabilities also. You have taken the money, you have taken the debt. Okay, you need to repay that. You need to repay the loan amount. So whatever liabilities you have, you will pay that. Suppose you have 25 lakh liabilities. Okay, 20 lakh liabilities. So the rest 30 lakh rupees is what? These are the actual value. Clear? So asset based valuation, it is mainly used for such firms who have their tangible assets. Okay, the machines, the equipment, the furniture, the chair, everything. So, and they have to subtract any debt or any obligation. See, debt, it is written as the debt, the loan, any obligation. So what is asset based value? Total value of assets minus total value of liabilities. So when the company gets liquidate, okay, so which method is very good for it? Asset based valuation method. When the company it gets liquidated, so from which method we will find the actual value of the firm? That is from asset based valuation approach. Tell me here, it is written at this line, very important. This method, look, wait, this method especially useful for companies that are not yet profitable or are in liquidation. Means for the liquidation purpose, this method is very important. Clear? Now, what is distressed firms? There is one topic, okay, in your valuation sub unit, are distressed firms. Means distressed firms are those firms that are continuously making loss, means that are not making profit, that are struggling. Okay, their time has come that these companies should be liquidated. Okay, the owner of the company gets bankrupt, the insolvency, means those firms who are in a very bad position. So these comes under the category of distressed firms. So distressed firms are companies that are struggling financially and they are unable to meet their obligation. Means these companies are not having adequate funds. They can pay off their liabilities also. Think such type of companies who cannot pay their own liabilities. So these companies comes under the category of distressed firms. They have negative earning, high level of debt. They may face the risk of bankruptcy or liquidation. Okay. Their stock prices are very low in the market, their shares are very low in the market. And in such situations, the investors and analysts may look at the company's asset and liabilities more closely so that they can find some way to make this company financially good. They can recover. With the help of proper restructuring, these companies may be recovered. Restructuring, these company may get recovered. Tell me, it is clear to you? Any doubt? Any doubt, anyone? We have completed our 16th unit. Means 4 units we have completed of our module C. Now the next unit, the most important unit, that the single unit they will give you 8 to 10 marks. 8 to 10 marks. And the name of that unit is what? Mergers, acquisition, amalgamation, restructuring, everything. Then can we move forward? Tell me. Well, see, mergers, acquisition, and amalgamation. What are these terms? Can anybody tell me? Can anybody tell me? Okay. So now let's understand the basic thing. Okay. I'm telling you over here only. Here, first. First is what? The merger. Okay. Now, what? Suppose there are two companies. Okay. Company A and company B. If company A, okay, company A takes the control of company B. Okay. Means company B is merged into company A. So they will become EB, means their functions, the both companies' functions have to be performed in these both companies. Okay, so A is taking the control of B. It means the whatever functions the B perform, the in if it includes in company A, the A has to perform, and the A is itself performing its own function. Why? Because this company is merging to this company. Clear? So either A existence is there if B merges into A, or B's existence is there if A merges into B. Either of the two existence will be there. So this will collapse. Okay. Or if A merges into B, so either the B will This will be the company, okay, B or A, but the control is of which company? The B company. So only one company's existence will be there. Rest the other company's existence will not go in the same manner, in the manner the previously that company was going. Clear? Tell me. Like mergers of few bank into one bank. The best example is merger of two banks into one bank. Like best example is SBI and its associates, five associates. This is the best example. Clear? Now, now what is acquisition? Acquisition. Suppose there are two companies A and B. Okay, A has acquired B company. So what happens? Or B have acquired A company. Then the one who acquires the another company becomes a parent company. Means A has acquired B company, so A will become the parent company, and B is what? B is becomes the subsidiary company, and it happens vice versa. Clear? And now the third is amalgamation. What is amalgamation? Suppose there are two companies called A and B, A and B. And when they both amalgamated, okay, they form entirely a new company that is C. Entirely a new entity that is C. So this is amalgamation. Vodafone and Idea. The best example is Vodafone and Idea. They amalgamated into each other and they formed a new entity called V. V for Vodafone and I for Idea. So V. Okay. This amalgamation took place in the year 2018. So this is amalgamation, this is acquisition, and this is merger. So I hope you have understood the basic differences between these three terms, the acquisition, mergers, and amalgamation. Okay, in amalgamation, what happens? Two companies amalgamated, they form entirely a new company that is C. In acquisition, what happens? The bigger company acquires the smaller company, takes the control of the smaller company, okay, and A becomes a parent company and B becomes a subsidiary company. In mergers, what happened? Either A existence is there if B merges into A, or B's existence if they is there if A merges into B. Means the existence of one company gets collapsed. Example is SBI and its associates. Now its all associates are where under the SBI only. Previously there were five associates, SBI of Jaipur, Travancore. Okay, there the basic difference between these three terms. Okay, now so it would be easy for you to now understand all the things. Should I move forward now? If you have understood the basic facts about these three terms. Okay, now so now a merger. Merger is what? It is the combination of two or more companies into a single entity. Okay, usually to achieve the efficiencies, to expand the market, to enhance competitiveness. So what are the types of merger? The horizontal merger. Horizontal merger means if the merger is occurs between the same industry. See, whatever I am highlighting, okay, or whatever I'm keeping in a box, that is most important. Means if the merger occurs in the same industry, that is horizontal. Okay, suppose one bank is merging into another bank. So both have are in the same sector, both are in the same industry. Two automobile manufacturers merging one into one. Now, what is vertical? Involves companies at different stages of the production process, such as supplier merging with a manufacturer or distributor. Means one level up So this is a type of horizontal merger. Vertical is like this. Okay, this is vertical merger. Means a supplier, okay, it is merging into the manufacturer. The supplier is merging into the manufacturer. Manufacturer is merging into the wholesaler, then retailer, then customer, then consumer. The consumer is what? The final user. Clear? Now, what is reverse merger? Suppose if there is a small company, let's take in what happened. Just a minute. Let me turn off the camera. Okay, suppose this is a small company. Okay, let's understand it is a company. Okay, this is a company. This is a big company. Let's assume this company. If this company takes the control of this big company, means a small company merging, okay, they takes the control of the big company, the unlisted company acquires the larger company. The larger company, it is listed in on a stock trade. Okay, if this happens, then that is reverse merger. A reverse merger occurs when a smaller company takes the control of a larger company. Clear? This is reverse merger. Clear? Now, conglomerate merger, when a merger is taking place between an unrelated industries, means the sector is not related. Suppose a food company, it is merging into a technical company, a tech company. So this is what? This is a conglomerate merger, means no link is there between these two companies. Food and beverages company is entirely different and tech company is entirely different. Market extension merger. Okay, means let's take an example like you have heard the name of pizza. Okay, Pizza Hut, the Domino's. Okay, or you can say like Centro, the Central Mall. So these are what? These are only one company, but they have their franchisees in different geographical regions. Means in different cities, in different places. So this is a type of what? Market extension merger. Means the we are extending the market from different from one place to another or from one region to another. That is market extension merger, so that we can capture the more market. Okay, we can retain more customers. Okay, with the goal of expansion and development of that particular company. Clear? Clear? Mm. Now, congeneric merger, or you can also say this as co-centric. So what is this? It is a type of merger between two companies that operate in related industries or sector. Okay, here it is same. The related industry and sector means it is a type of, you are thinking of you can say horizontal merger. No, but after that, one statement is also there. Typically offering complementary products. Complementary products means what? One cannot go without other. You have you have heard of two words, complementary and substitute products. So complementary is what? One cannot go without other. Means like uh, petrol and car. If there is no petrol, there would be no such kind of vehicle. If there is no car, so what is the use of petrol? Clear? So both have to go. Without this, the car cannot go. Means car needs fuel, and fuel is in the form of petrol or diesel, like bread and butter. Okay. Earlier days, the bread and butter was the favorite thing for the kids. Bread and butter. So means one cannot go without the other. It means if I am making a car, okay, I'm manufacturing a car. So I need many things of the car. I need tire, okay, I need the glasses, I need the proper, you can say the windows, okay, I need a sterling wheel. So I need many small, you can say the nuts, the screws, many small components of the car. So So for this means without those components, the car cannot be structured properly. So they both are important. So this is cogeneric and concentric merger. If the car manufacturer, if if the company merges into the car, the car components company means the company who which is making the component of the car. So that is a type of cogeneric or concentric merger. Yeah. So these companies are not the direct competitor because without the component, car cannot be structured properly. But still, they can impact one another. Company that manufactures home appliances may merge with a company that makes a component like motors or circuits, which are used in the home appliances. Clear? So means one focuses on the finished products and the other focuses on the part of that product. So both are important to one another. Without one, the other cannot work. Without other, the one is useless. Like planning and controlling. Like planning and controlling. We have seen na, कि planning and controlling both go in hand. Without planning, controlling it's of no use, and without controlling, planning is to be made it as a useless. It is termed as a useless. Yeah. So similarly, cogeneric and concentric merger is a type that type of merger. Tell me, any doubt to anyone till now? And please, everybody, like the session. If you feel this session helps you in any way, okay, you are understanding the content, you are understanding the explanation. So just you have to do what you have to hit the like button. Okay, you have to press the like button. Okay, now I'm moving forward. I hope you have understood this. Chalo, let's move forward. So this is what I have explained you merger. Okay. If both it's a combination of two companies A and B, so they form AB together. But the work of only one company will be take place. Okay, acquisition. The bigger company acquires the smaller company and it becomes A. Or if the B is bigger and A is smaller, so in acquisition, the B company existence is left. Now, you have understood what are mergers, all the types of merger, the six types of merger. Now, next comes the acquisition. So, acquisition is what? There are one is acquirer, the one who is taking the acquisition, the one who is doing the acquisition. And the company which is being acquired is known as the target company. Okay, okay, suppose I am I want to acquire the company. So I'm acquirer and this is the company which I want to acquire. So this company becomes what? The target company. Clear? So it is a process where one company what? Acquirer buys. Who is buying the company is called acquirer, buys another company and that another company is what? A target company. And why this acquisition has been done? To gain all the control, to control all the assets, to gain the, you can say their expertise, their operations, their resources. Okay, so they are combining. And in merger, what happened? The combination of two companies are there, whereas in acquisition, the big company controls the small company that is the target company. So there are two types of acquisition: the friendly, where both the parties agrees, and hostile, where one party, the target company, does not agree. And what are the reasons for market, for expanding market, to enter new market or increase market share? For the diversification, okay, if you want to diversify your product line, if you want to diversify your industries, then excuse me, okay, so sorry. Now, what is cost? What synergies? For cost synergies? So can anybody tell me what is synergy? Can anybody tell me what is synergy? I'm having little bit cold. Okay, can anybody tell me what is synergy? If anybody of you knows, see, what is synergy? It says that the value of company A and B together, okay, will always be greater than the value of single company A plus the value of single company B. So if both companies come together, they will work in a proper way, they will work in a very good way as compared to the companies who are working individually, who are working alone. Okay. So if, for example, if the value of the company A is 200 crores and the value of company B is 200 crores, so together they will frame a value of what? 500 crores. So this is what? This is synergy. To achieve economies of scale and to reduce the cost. Increase the economy of scale and economy of scope. Clear? So this is what synergy. Later on, we will be learning more about this for strategic growth. Okay, for accessing new kind of technology. Okay, human resource for intellectual property and eliminating competition. If there are more competition, then for every company it is very difficult to set a benchmark, to set a standard. They merge together to if they work merge together and if they perform in a better way, then it will help the to reduce the competition in the market. Yeah. Now, purchase of division of plants. Okay, for example, Shriram Fibers India. Okay, Shriram Fibers company. This company has acquired C8. Okay, bought laboratories and paid $3.72 billion to acquire pharmaceutical business of Pyramid Healthcare. Okay, first company Shriram Fiber India acquired C8 Limited Nylons. Okay, then Abbott Laboratories paid how much? 3.72 billion to acquire the pharmaceutical business of Pyramid Healthcare. Means two companies have been acquired to another. One is Shriram Fibers India acquired C8 Limited and bought laboratories they paid to acquire the pharmaceutical companies. Now, what is takeover? Takeover is another type of acquisition. Okay, one is acquirer and the company which they want to purchase, which they want to acquire, that becomes what? Target company. The same what we have read in our acquisition. A takeover often comprises the acquisition of a specified interest, typically between 50 to 100%. Clear? No. Leveraged buyout. What is leveraged buyout? Leveraged means what? The borrowed money. Okay. If you are purchasing, acquiring any other company with the help of loan, that is leveraged buyout. Means any other company is being acquired. Suppose this is the company and this is me. I want to purchase this company, but the value of this company is let's say 25 crore. But I have only 20 crore in my hand. So what I will do? I will go to the bank. I will take a loan of let's say of 10 crore. Okay, uh, I will keep the 5 crores for our future use. Okay, I will give him the owner of this company 25 crores and I will acquire this company. So what I'm doing in this case is I'm taking the assistance of a loan. I'm taking the help of a money as a loan from the bank and then I'm purchasing any other company. So this is leveraged buyout. Means with the help of leveraging, you are buying another company. Clear? With the help of loan financing. And what is divestitures? Okay, Again, when compared to divestitures, acquisition lead to an increase in control and a larger asset base, smaller asset base means selling a part of your division, a part of your company to another company, that is divestitures. Later on, we will be learning more about this in the coming slides. Tell me, till here it is clear to you all? Now, what are the reasons for mergers? We have seen for synergy, for taxation. Okay, if there is merger, then I have to pay less tax. Okay, tax exemptions will be there. Growth, for the growth of the, you can say, company, for the expansion of the company, growth of the economy, the consolidation. Okay, for economies of scale. Economies of scale are what? They refer to the cost advantage. Means as the production increases, means as you will increase the production, the per unit cost will decrease. Per unit cost that of a product will, what happens? It decreases. So as more and more productions will increase, okay, the per unit cost, the average cost per unit, it will tend to decrease. Because suppose you are producing, okay, 10 units of goods in a day with the same electricity, okay, with the same manpower, with the same machines. But if so, everything will same. Everything is the machines, the electricity, everything is coming a same value. Okay, but this if the production increases, so what your fixed cost was, it will be the same for every unit of output, but the variable cost, they will what? They will fluctuate as and when your units increase or decrease in for the production, so variable cost will fluctuate. So if more and more units you will be producing, then the per unit cost, the value of the per unit will decrease, with the result in the fluctuation of variable cost. Okay, so this is known as the economies of scale. As a company produces more units of goods and services, average per cost unit tends to decrease to the spreading of fixed cost over a large number of units. Clear? Then economies of scale, we have done. Scope, then vertical integration. Okay, that is if a supplier will integrate to manufacturer, okay, for the goods, then manufacturer will sell those products to the you can say wholesaler, then wholesaler to retailer. So in this there will be integration, a vertical integration will be there. Resources, everybody will use resources in a proper optimally, okay, optimum utilization of resources will be there. Utilization of surplus funds, effectiveness will be there, efficiency will be there. Industry consolidation, if two industries are working in a same sector, they might consolidate their expertise so that a new business model can develop. Okay, then reasons for merger. So some company might think that with the merger, what happens? Our expertise will go down. So no, it's not that. With the proper merger, what happens? Both of you will use the same expertise. Okay, your different expertise in that particular business. If both will come together, they will work in a better way. And with this, the risk will also be minimized. Okay, risk will also get diversified, where only one company manages the risk. If two company comes, A and B all together, if they merge, then the risk they have to manage by both of the companies. So there will be diversification of the risk also. Lower financing cost. The financing cost will low down. Okay. The per unit cost of production, what happens? It decreases. And definitely if the per unit cost will decreases, so our earnings will increase. If earnings will increase, profit will increase. Profit will increase, value of the firm will increase. Clear? Tell me, it is clear to you all? Okay. So this was the reasons why merger is important in our company. Okay. What happens? What is the positive impact that happens on the following on the concerned company? Now, mechanics of merger. Okay. So mechanics of merger means the mechanics means a type of process. So it refers to the detailed steps and processes that are involved in combining two or more than two companies. So we know that merger is a bit complex transaction. Okay, you need to find out the company who is very competitive. Okay, who has earned more revenue, more earnings. So you need to get the integration between these two companies. Then only you can merge together. So there are following things you need to keep in mind. Okay, the proper rules and regulation procedure is there. You need to keep all these mind. First of all, in-depth analysis of the object clauses. Okay, why do you want this merger? You need to do proper analysis. Then you will communicate with the stock exchanges. Okay, this is the company. I want to merge this company. So what will be happen? What my shares will be? How much dilution I have to give? Okay, how every if the company is merging, definitely people are also including. Okay, there will be a large number of people in the company. So we can't say कि only our people are the owners of the company. So their shareholding is also some people might be of their company also, where which we have to give the shareholding. So we need to communicate that with the stock exchanges. Then board approvals should be there, okay, of proper amalgamation. Then application, we have to give this application to whom? To NCLT, that is National Company Law Tribunal. Okay. After filing the application, you have to give the notices to all of your shareholders, debenture holders, the creditors of the company that we are going to do a merger with this particular company. So for this, you need to conduct a meeting. You need to take their consent, because ultimately the shareholders are the owners of the company. Na, you need to take the consent. Okay, the board of director meetings, the shareholders meetings, it will be conducted. Then you have to file the petition to the NCLT for its confirmation. Okay, the order copy should be also sent to the registrar of companies, ROC. After that, transfer all the assets and liabilities. Okay, the company, which company is being merged. Okay, all the assets and liabilities has to be transferred. If there is any kind of liability, you need to pay that, and all the assets will also be transferred. Then what you have to issue your equity and your debentures in that new company. The new company which has been made by with the mergence of two companies, then debentures, shareholders, you should issue to them. New issue will be there. Clear? So this is the process of what? Proper process of merger amalgamation. Clear? Tell me. And please everybody, okay, don't forget to like the session. Now, accounting for business combination. Okay, what is combination means? Togetherness. So business combination means it is what when one company takes the control of another company, and this can happen in various ways, by transferring all the assets, by transferring all the cash reserves, by taking the control of the target company, selling our ownership to another company. In this way also we can, what we can sell, if we are selling our ownership, we are taking the control of that such companies, offering multiple types of consideration. So business combination can happen for various reasons. According to Indian AS accounting standard 103, so okay, so there are two main methods to account for this combination. One is the normal method, the acquisition method. There is one acquirer, there is one target company. This acquirer wants to purchase the company. This is the target company. And the pooling method. Okay. Can anybody tell me what is pooling method? Can anybody tell me what is pooling method? Okay. So pooling method is what? It is a method, accounting method, which used to combine the balance sheet of two companies. And which two companies? The companies which are being merging together, merged or acquired. Okay. It was phased out in 2001 and it was replaced by which term? Purchase method. Now pooling method is known as purchase method. So exchange ratio in a merger. If a merger is to be happened, okay, what is the exchange ratio? So exchange ratio is what? When one company buys another, they often exchange shares. Exchange ratio is determined. So you can say different factors are required to calculate the exchange ratio. The first is book value per share. That is the value which is written in the book. This compares the book value of each company. For example, A's book value per share is 25. So what will be the exchange ratio? That is 25, and company's book value per share is company B 50. So the exchange ratio is how much? 0.5. Clear? Suppose if the A's book value per share is 10 and B's book value per share is what? 5. So what will be the exchange ratio? It will be the 2. Clear? So like in this way, you have to find what? Exchange ratio. So now earnings per share, that is EPS. Okay. Company earns rupees 10 per share and company B earns rupees 5 per share. So what will be the exchange ratio? That will 0.5. Okay. Market price per share MPS. Again, you have to divide the company's A share is 100, company's B share is at 25. So what is the exchange ratio? That is 0.25. Okay. Dividend discount value. Dividend value is given how much? It is given 50 and B is 50 and A is 80. So 0 point. It will 48, 6. It will be 6 to approx. Okay. Yes, it is written. It is 0.625. Okay. So this method works well when future dividends can be predicted, when we can predict the future dividend in future, what will be the dividend given to its shareholders. Discounted cash flow, it considers the discounting, that is time value of money. So if the company's A value is 40 and B value is 30, so 30 upon 40, that is 0.75. Clear? So in this way, we can find what? Exchange ratio. We can find the exchange ratio. Clear? Tell me. Now, takeovers. So takeovers can be done in following ways. In open market, okay, in open market purchase, when everything is being, you can say determined, okay, everything is being said, negotiated. Acquisition means a proper negotiation is done between on the price. Okay, the other company will say, I will sell you in 10 crore. The one company is saying, no, I will purchase you on 15 crore. Okay, so this is the negotiation. Then preferential allotment. It is a process where company will issue shares, their securities, okay, to a select group of investors on a discounted price. Means they are given a preference. Okay, first preference they are being given to investors because the company is being selling, showing its share and securities on a discount. Okay, so that the company's capital may be raised. So the purpose is what? To raise capital for the company. So, what regulation for takeover of existing company? Takeovers can be a useful way for companies to gain the control of other, but they need to be properly regulated to ensure the fairness and transparency. So, you should look the fairness of that company. No data, no information should be hidden. Everything should be transparent. You should also protect your minority shareholders' interest. It's not that you are neglecting them, you are ignoring them. No, you should also consider them also, and prevention of abuse. Now, SEBI. We need to take the guidelines of the SEBI for the takeover. If we have to do the takeover, we need to follow the code of conduct of the SEBI. The first is the disclosure. Okay, it should be more than 5% of the company's total stock. The holdings in the company should be. Then trigger point, that is the announcement should be done in public. Okay, this much shares I'm acquiring through your IPO. Then merchant banker, okay, hire category one merchant banker who is to be registered under SEBI. What is SEBI? Securities Exchange Board of India. Okay, then public announcement. After that, announcement should be done within the all the public within 4 days. All the information regarding the minimum offer price. Ki minimum means the initial offer price should be given before the acquisition. So it needs to be known to all the public. The announcement should be done. Then the offer price, the price that will be offered to the general public, that is offer price, and the responsibilities of the acquirer means letter of offer is delivered to shareholders within 45 days. Okay, everything is done. You need to what? You need to provide the offer letter to the shareholders, so they should also be know that what is happening. Okay, how much is the shares? How much is the percentage we are offering to the public company, to the company who might need to be acquired, or the other company who might need to take over the company. Okay, so letter of offer is to be delivered to them as well as within 45 days. Clear? Now obligation of the board of the target company. Okay, so the company which we need to take over, which we need to acquire, so we are not, so this target company is not allowed to dispose of their assets or issue any kind of capital because they have been entered into an agreement. Okay, so they if they want to do this, they can do it before, but after entering into a significant contract, they cannot do that. Bids from competitor within a period of 21 days, the public release initial offer, the bids can be made, and then establishment of an escrow account. So escrow account is what? The acquirer is obligated to place at least 25% of the consideration payable for the public offer up to 100 crore and 10% of the consideration up to above 100 crore. Means up to 20 to 100 crore, okay, you need to place at least 25%. But if it is more than 100 crore, मान लेते हैं, for example, let's take 120 crore. Now you need to pay above is how much? 20 crore is more than 100 crore. Now you need to pay the 10% of the consideration. Okay, you need to pay how much? 10% of the consideration above 100 crore. That is in an escrow account. Here, where means 25% you have to pay above, additionally 10% you need to pay. You need to keep it in that account, not pay, you have to keep it in that escrow account. Am I clear with this? Okay. Now, what is restructuring? So, restructuring means what? You are doing a restructure of the business. Re means again, and structuring means the creating a proper structure of that company. So, it is undertaken by a company in order to do modification. You will improve that company. Okay, you will do required modification. You will reshape its operation. Okay, by increasing its efficiency. So restructuring includes organizational restructuring. If we want to do the restructuring, and then within the organization, in the internal factors of the organization, in the finance sector, or in the operational means day-to-day transactions, what happens day-to-day business transactions, that it also needs to be restructured. In financial, two more components it includes. The one is equity and the other one is debt. Anti-takeover defense. Can we before that any doubt anyone? Anti-takeover defenses are what? Suppose this is you, this is target company. You want to acquire this target company, but this target company does not want to get acquired in you. Means this target company does not want to get you can say does not want to get merged into your company. So this target company, what it will do, it will take the defensive measures so that takeover may not happen. So there are two types of measures they can take. The pre-offer defenses means before the offer has been delivered, before the offer has been made, then this company can take the defense, okay, defend it before pre-offer, or after post offer means when the offer has been given, okay, then what are the method, what are the ways the target company can defend it from being merged into the other company. So pre-offer defenses, it includes staggered board, okay, where every year the board of directors has to be divided into three groups and every group has to be selected. Okay, each year one director has to be selected. So what happens? This will take a lot of time. So for this, the acquirer, the acquisition, it takes a lot of time. Then majority clause means majority of the people should agree on this matter, then only the takeover can happen, otherwise not. Poison pill, the shareholders will be given the right to buy those shares at a discount. So what happen if they will buy the shares at a discount, then their value will decrease. And if their value will decrease, the acquired company will see that this company, because company's value is from where? From its shareholders, from their assets. If the value of these two has been decreased, then why acquisition will happen? Okay. Poison put, the redeem should be happened early. That can be redeemed early. Okay. Dual class shares, new shares with a better voting right can be created, giving certain shareholders more control. So this can happen with pre-offer defenses. But when the offer has been given, then what are the things you can do? Green mail. Okay, you can, the target company can buy back its own share so that the takeover they can prevent. Okay, Pac-Man defense, they can make a counter bid offer. Means one bid, if one bidding has happened, the target company gives another bidding. The counter bidding they can do to acquire the company that is trying to take it over. Okay, means counter bid means that suppose I want to acquire this company. Now this company's owner, this company has done the counter bid, means now his company is being acquired. This is counter bid. Litigation means legal, more legal laws you have to follow. Okay, violations, claiming that this acquirer company has broken the law, has broken the legal laws. If the restructuring is being done for its most valuable assets. Okay, if the target company is selling their most valuable assets, so their value will decrease down. So it will become the less attractive for what? For the acquirer. So liabilities, they are also, if more and more liabilities will be there, so why would one company will think to acquire this target company? If this target company is big, if they acquire this target company, then they have to pay the liabilities, na? So this is also one of the method, the post offer defenses. Okay, anti-post or anti-takeover defense में preferential allotment, okay, creeping enhancement, they can gradually increase their shares, okay, but these shares have to be followed under the SEBI guidelines. Amalgamate, if they do amalgamation, then what amalgamate group companies means? Combine smaller companies within the same group. Means there is one large group, okay, you need to do is, if you have to amalgamate group companies, means you have to come, there are different smaller companies. If all these smaller companies are combined within the same group only, okay, so what will happen? If the same group, the company has been combined, they will become a very larger group. So if this becomes larger, then it becomes difficult for the acquirer to acquire this particular company. Clear? Now, sell the crown jewels means if you will sell your most valuable asset. So your company is not having anything valuable. So why would the acquirer will purchase your company? And white knight, that is, you will take the help of your friendly company. They will help you. Okay, they will take your few shares. They will take your few assets. Okay, just to keep it hold so that you can defend. You can take the action against the takeover. Yes, so these are the few ways when the offer, before the offer has been made, then what are the defensive techniques you can take? After the offer has been provided to, what are the defensive techniques a target company can take, and anti-takeover defenses in India. Clear? Now, now leveraged buyout, I have explained you this. Okay, what does it means that using a lot of debt to buy a company means with the help of leverage, with the help of borrowed capital, if a person is buying any other company with the help of borrowed capital, that is leveraged buyout. Clear? Now, business alliances, what? These are the joint ventures, strategic alliances, equity partnership, licensing, franchising, where two companies they come together with their own expertise and they work together. So these are what business alliance. Both of them come with their own experience. They form a company. They work what the motive which has been made for the, you can say, see what happens when two companies come together, okay, with their own experience. They have their own experience. This company, they have their own experience, okay. They work together for a specific purpose. Once the specific purpose has been over, they both go in their own direction, okay. For example, General Motors and Toyota, they formed a joint venture, okay, in 1980s. Merck has found an R&D. IBM formed a partnership. Means both come with their own expertise. So what are the reason? The risk can be minimized. They can enter into new market. Cost can be reduced. Okay. Favorable regulation system should be there. Okay. Regulators can view them and they can have a basis for acquisition also, for exit also. And what are the success they get? The strength, cost effectiveness. If they will share their cost, their R&D, their expertise, so everything will work in an effective manner. Collaborative goals are there. They know their clear roles and responsibilities. And the benefits, fair distribution of benefits and aligned expectation means they should match accordingly, okay. So both partners should know their financial goal, they should work on it, and once the work has been completed, okay, they can they can de-merge from that. That is aligned expectation. Clear? Now, five cents of acquisition means bad when bad impact can be there on acquisition, so they are known as five cents, okay. So if you go very far away from it, means in the acquisition process you have gone so far that you can't reverse back, that you can't get back. So this is might one of the issue, one of the problem of acquisition, okay. Striving what? For greatness means you are you know that why you are acquiring this company, you are acquiring for your betterment, okay. If if not betterment, it may lead to a bad impact. Then what happens? Suppose you have acquired any company and in future this company is not working well, okay, this company is continuously giving you losses, continuously giving you negative earning. So what happens? You can't go back, okay, you can't whatever you have done mistake, you can't correct your mistake, you can't rectify that. So it means striving for greatness means you have thought that this company will give you a good returns, okay, a future good positive cash flows. It will generate you a good money, but it is not happening. Plunging without thinking, you have acquired this company. You don't know the ins and outs of this company. Then also it can create a great problem. Overpaying the target company means you know the target company worth is 10 crore, but you have paid it a 15 crore, so it will also create a bad impact. And if the integration is not well, if there is inability to integrate well in that company, then that company will also give you the bad impact. So these are the five sins of acquisition and it is most important. Clear? Now, what is a holding company? So a holding company is a business entity, okay, which has its own subsidiaries. Means holding, you can say a parent company, and under this company another company is working as subsidiary company. So this parent company is taking the control of this company, more than 50% control. Okay, more than 50% control, then that is a parent company. And if less than 50% control, that company is called subsidiary company. So parent or holding company, company A, wholly owned subsidiary, that is 100%. When a subsidiary company is wholly owned, when a subsidiary company is partially owned, that is 75. Okay, and a subsidiary company is what? At least 50%. Means subsidiary company should have 50% of the share, partially owned subsidiary company should have 75% of the share, and wholly owned subsidiary company should have what? Parent company should control its 100%. Okay, parent company or holding company is taking 50% of the share, then that is subsidiary. More than 50%, but less than 76%, that is partially owned, and 100%, then that is wholly owned subsidiary company. Here, tell me, any doubt to anyone? We have completed mergers, acquisition, and restructuring unit. Okay, now next unit is what? Unit number 18. So this was the most important unit, mergers, acquisition, and restructuring amalgamation. So I hope all these things have been clear to you. Okay, the acquisition, business alliances, types of mergers we have done, then anti-takeover defenses, pre-offer defenses, post-offer defenses, everything we have done. Any doubt to anyone till here? Please tell me if you are having any doubt. Mm. Can we move forward? Now, okay, we have done the discounting, we have done the valuation, how to make the valuation, okay, how to get the correct valuation of a particular company, of intangible, of tangible nature. Then we have done mergers, how to merge a company. When two companies are merged together, what happens? When one company acquires the target company, what happens? When both company amalgamated together and they form entirely a new entity, then what happens? Okay, what are the defensive actions target company has to take when the takeover is done in a hostile manner? So all these things we have done now. Okay, now last comes is what? The dealing. Okay, everything is we have done. Now last comes how we can deal with that. Okay, how the negotiation can be done. Okay, so in dealing, in deal structuring, okay, of and financial strategies, we are looking that the agreement between two parties will be done in what manner. So an agreement between two parties, the acquirer and the target firms, specifying their rights and obligations, is known as deal structuring. Okay, they are defining their own rights. Other companies defining their own liabilities. Okay, my company, the target company says, okay, I have this liabilities. If you will acquire me, you need to pay off all these. The acquirer will say, I have these following rights. Okay, the expertise I have in me, I can make your company very good. We will together make a good company. We will together come and we will achieve many new targets. Okay. So these are the things they will done. It will happen under negotiation about the price. The most important is price. The acquirer will say, I will purchase your company worth rupees 25 crore. The target will company say, no, I will sell my company in 35 crore. So these both are, they both are, you can say, this company is saying I will uh, pay only 25, and other company is saying कि I will only give you 35 crore. So the negotiation will have to happen. If both company agrees, then there's a win-win situation. If one company is on one company's loss, the other company makes profit. So what is that? What that becomes a deal? Okay. So deal happens in various ways. Now, what are the payment and legal consideration? Okay, the payment can be made in cash. The payment can be done in cash also. The payment can be done in shares. So if payment can be done in shares, what is the benefit they will get, the acquirer? What benefit the acquirer may get? The benefit of what? Tax benefit. Tax benefit the acquirer may get. Okay, or the combination of cash, debt, stock, combination of these three. So it depends on them what type of they will use. Okay, what type of consideration they will use, either in cash, either in stock, or either in debt. So form of acquisition and post closing organization. So it is necessary to take into consideration all the elements. Okay, the cost, what is easy in which the ownership can be transferred, the easy method in which the with which ownership can be transferred to the company. If I want that, okay, I want the ownership, okay, of your company, you need to transfer that. I want that I only need the help of your company, okay, I don't want to take the full existence, full I you can continue your company, okay, your existence will not be ended. I just want to take the shareholding. Then the management control. Who will control that company? I will control, or any manager of your company will control. I will give him the right, the authority. The convenience of financial support, ease of assimilation. It is easy to get assimilated into the system. That will create benefit or not. Okay, the manner in which earnings shall be distributed, how much dividend I have to pay, okay, how much reserves I have to keep, what responsibility will be given to what person, which person will be taking which kind of responsibility, and taxation. So these are the things, these are the steps that need to be looked forward, okay, before considering into a proper decision, before making any kind of deal. Clear? So post closing organization is what, this is most important, okay, selecting a suitable after closing this deal. Okay, what should be the best case by, if you will close the organization, if you will close the deal, okay, what activities you have to look take care of. The acquiring company may opt for a structure that makes post closing integration easier. Okay, it can reduce the risk of the target company. If my if my liabilities are not known, if the target company's liabilities are not known, but if we together, if we will work, then with the help of that, I may look that what my liabilities were earlier, what my liabilities are now. So with this difference, I can easily find out your liability. Okay, so it minimizes risk. Then a financial buyer can choose a holding company structure. Okay, if I want to make any kind of, okay, so for deal, okay, for acquisition, what happens? We will later on learn this chapter SPAC in our module D. A new company is to be created for the proper acquisition scenario. Okay, SPAC, that is special purpose acquisition company. So these companies has been made specifically for the acquisition of any other company. So with the help of this company, I can do all these things. Or if any NBFC is there, if any financial buyer is there, he can choose a holding company structure. Means holding company structure means more than 50% of the shares should be carried by a parent company or holding company. Then if the value of tax benefit is large, and it's a benefit of, if the value of tax benefit is large, definitely risk will also be high. So what would be the best option in that case? That is the, we will do a partnership together or joint venture. So joint venture is what? When two companies come together with their own expertise. with their own expertise. They work on it, and after working, okay, what happens? They earn a huge profit from that expertise. Clear? So these are the suitable post closing organization, the all the factors you need to consider. Think it's better to make any kind of company, any kind of special purpose acquisition company for the acquiring purpose. If any financial buyer is there or any NBFC company, so it is better to choose a holding company or a parent company. Okay, at least 50% of the share parent company should hold, 50% or more than that. Yeah, more than 50%. And if the tax benefit is high, if the value of the tax benefit tax exemptions those are getting high, then the risk will also be high. So it will be best option that if you will make a partnership firm or if you will work on a in a joint venture. Clear? Now, different types of payment consideration again, either in cash, if we want to close this deal in a cash, in a non-cash, mixture of shares and a cash. So with the shares, what happens? You get a benefit of tax, or with your convertible securities, means those securities which can be converted into equity later on. Okay, after a determined time. After a determined time. Now, what are the tax reliefs and benefits that get a company gets in case of amalgamation in India? If they can get the tax benefit in terms of capital gain, and it comes under Section 47(6). Okay, allotment of shares in amalgamated company to all the shareholders of the another amalgamating company, the one which is being amalgamating. So this comes under Section 47(7) and 49(2). Capital gains exemption comes under Section 47, 6, subsection 6. And shares, allotment of shares in one amalgamated company to the shareholders of another amalgamating company. Two companies are there. One is acquirer, another is target company. So they both comes under the Section 47, subsection 7 and 49, subsection 2. Okay. Now, and if there is any kind of carry forward and setup, means what tax relief is given to the amalgamated company. Okay, suppose this is the target company. I am acquiring you. I know your company has made a very huge loss, so I can forward, okay, that what relief the tax give. Okay, the government gives that your loss can be carry forward, they can be set off. Okay, and unabsorbed depreciation means your loss can be carry forward, of losses and depreciation, unabsorbed depreciation would be set off. Here, so these are the benefits that we get under the tax relief. You can say bracket. Here, any doubt to anyone? Tell me any doubt to any of the topic? Can we move forward? Okay, now let's move forward. Okay, so till here we have seen that the all the losses can be carry forward, all the unabsorbed depreciation can be set off. But the benefits under this section with respect to unabsorbed depreciation and carry forward losses are only available if the following conditions are met. What is the condition? There should be an amalgamation of a company who is owning an industrial undertaking. This is very important. A banking company who is being referred under Section 5, subsection C of Banking Regulation Act 1949. One or more public company or companies engaged in the business operation of what? Aircraft with another one or more another public sector company, or any specified bank, which means any SBI constituted under the SBI India Act, amalgamated company. Okay, I'm giving you this provision for what? If your company is if your company is being or incorporated in an India, means you are following the provisions of the Indian Act. Then only I will give you all this provision. You can carry forward your losses. You can set off your unabsorbed depreciation when you are doing amalgamation. Here, tell me, any doubt to anyone? So all these benefits are given to whom? Only to those amalgamated companies who are an Indian company. Because we will not give all the benefits to any foreign company. We will only give the benefit to amalgamated company. Clear? This slide from the deal structuring unit means all these slides are very important. Okay, I'm giving you 1 minute. Read these slides. If any doubt comes to your mind, please ask me. Okay. After a few seconds, I will shift the slide to the next one because these two slides are very important. Okay, I hope you have read this slide. Now, this one, any doubt in this particular slide? If any doubt comes to ask me because these two slides are very important under Unit 18. Okay, what conditions you have to fulfill if you want to get the tax benefit of unabsorbed depreciation and carry forward losses. Okay, so these were the few points. I made you clear all these things. Okay, clear? Now, next topic. What is the topic next? So, all these things we have done. Okay, these two lines, these 3 points, point number one, point number two, point number three. These three are also very important. Chalo, now move to the next point, that is MAT. What is the full form of MAT? Very important. Minimum alternate tax. The full form is important. Second, this MAT comes under which section? That is section 115 JB of Indian Tax Act levies MAT on a company. Okay, so what is MAT? Suppose what happens that if a company is earning like 25, okay, 25 lakh rupees. But this company, from this 25 lakh rupees profit, this company shows that on unabsorbed depreciation, on losses, okay, all these things I have made a loss of 10 lakh rupees. Now, if they have showed this, so what is the remaining amount? That is 15 lakh. They will show to the government, I have only made a profit of 15 lakh. Now 15% I have to give under the tax provision, the as corporate tax to the government. So government thinks, okay, this company is making me foolish. This company is the actual earnings, the actual profit of this company is 25 lakh rupees. But with the help of unabsorbed depreciation, with the help of different type of losses, with the help of expenses, okay, this company is showing its profit only 15 lakh rupees. And from this 15 lakh rupees, I am also getting a very less tax. So this company is what making me foolish. So what government has told that, okay, so this was the problem arising. Every company, every after one another company, every company was doing the same thing. Okay, they are showing their losses more, they are showing their expenses more, and they are giving they are not going coming under the proper tax liability, the proper tax slab rate. So what government has done that they have introduced a concept called MAT. Means I don't know. Okay, whatever your minimum liability comes, minimum alternate tax comes, you need to pay that tax. Okay, general provision under the tax or minimum alternate tax, whichever is more, you have to pay that amount. Or what is the rate? That is 15%. Means if you have made a 25 lakh profit, you will calculate its 15%. And under the normal tax consideration, if you have calculated your profit on 25 lakhs, your profit comes, let's say, 1 lakh rupees. Here your profit comes with this MAT, your profit comes 2 lakh rupees. Now, which whosoever profit is more, you have to give me that. Now, 2 lakh rupees the corporate owner has to pay to the government. If this comes 2 lakh rupees, this comes 1 lakh rupees, still they have to pay the more of the amount. So this is how government, they have played a very good game from all these companies who are making them foolish. Okay, so this was the tactic they had. Now, availability of MAT credit. Okay, the credit is also given to them. Okay, I will give you certain credit. That is, it levies MAT on a company if the amount of income tax payable general provision is less than 15%. If the tax rate under this provision is coming less than 15%, okay, you have to give me 15% of your book profit. Okay, you have to show me 15%, but later on I will give you that credit whatever your tax are. Okay, let's say your tax comes, let's say of 12%, and my tax is the rate fix is 15%. Okay, give me 15%, but later on what I will do is I will give you a credit of 3% later on. So this is how they work. This is how the MAT provisions are being, okay, set in the companies in the corporate sectors, and this is how they have to pay their taxes. Clear? Okay, I hope this the concept of MAT is clear to you. Minimum alternate tax, very important. If no, then please ask. Okay, so yes, our third module is being completed. Okay, so it took 2.5 hours to complete the whole module C. Now, okay, let's have a break for 10 minutes. Okay, go and eat something if you want to eat. Okay, if you want to drink water, do it. So, let's have a break for 10 minutes. After 10 minutes, we will rejoin and we will start with module D. Okay, and if you are having any problem in related to this particular module C, okay, you can ask me, you can put all your queries in the comment section box. So, I will definitely going to resolve all of your queries. Clear? So yes, stay connected with me. Stay connected with me till now. You have connected with all the things we have completed. Okay, the tax benefit we have done. This holding company acquisitions. Okay, alliances. Then we have done the leveraged buyout. Everything we have completed in module C. This module C was a bit lengthy one. So any doubt, any confusion comes to your mind, please do ask me. Okay. Okay, so let's have a break for 10 minutes. Okay, we will rejoin after 10 minutes. Please tell me, everybody, am I audible? Am I audible? Okay. So just wait for 1 minute more. Okay, let me change the PPT. And once if new PPT uploaded, okay, then please to confirm me that. Are you able to see that new PPT or not? Okay, please confirm me. Is my new PPT, are you able to see my new PPT? Is that visible or not? The introduction section of new module. Hmm. Please confirm me, everybody. Okay. So yes, now we have to start. We have completed module C. I hope everything is clear to you all what we did in our previous module, module C. Now we have to start module D. And what is the name of the module? Emerging Business Solutions. Module D, Emerging Business Solutions. Okay. So this module is basically it what it says that it says a new era of business, new or modern era of business. Okay. So modern era of business, what it denotes that we have new type of startup finance, we have hybrid finance. Okay, we have sustainable financing, which indicates that whatever we will in whatever project we are going to invest, we have to take care, we have to take a consideration that it should not harm to our environment, it should not harm to our society as well, and it should follow all the moral values, all the ethics. Mm. Yeah. So all these things we have to learn in our module D. So let's start with the very first unit, that is hybrid finance. Okay. Now, what is hybrid? The word hybrid means what? The word hybrid means it is a mixture. Okay. It is a combination. And combination and mixture of what? We are talking about finance. The word finance is also included. So in finance, we have two elements. One is debt and the other one is what? Equity. Again, hybrid finance, it includes what? A mixture of debt and equity. Here, these both all together, how they will work. Hybrid security is a financial instrument that includes the characteristics of both debt and equity. And these securities, they will help in the investor, okay, with a blend of fixed income and well as the capital appreciation. So what are the advantages of hybrid finance? It is flexible, okay, because company can choose the best mixture of both debt as well as equity. So whatever the financial strategy they have formulated, so accordingly that which is suitable to them, they will choose accordingly that the mixture of both debt and equity. With the appropriate mixture of debt and equity, they can diversify their risk. Okay, they know that their firm has they have very levered firm. So definitely they will not going to take more and more debt. What they will going to take, they will take the help of equity. Okay, they know that they have equity shareholders. Okay, there is no debt in the company, so they will take more and more debt in order to make their earnings more. So there is a risk diversification. With this, they can diversify their risk also, and they can also have the flexibility to use these two elements. Now, attracting different investors. Okay, it can appeal to a broader range of investors that will help both in their income and growth. The, the market is less volatile, means the market fluctuation is not happening that much. Means there is no high inflation, there is no less deflation, there is no less inflation. Okay, higher yield. With this project, okay, with this composition of two elements, they can make more and more earnings because they have chosen these two elements on the basis of their strategy, on the basis of their financial strategy related to their business operation. So yes, whatever they have chosen in a perfect manner, in a for making their organization to work in a smooth manner. So higher yield, that is, they can generate high profits. Clear? Now, what are the disadvantages? It is again a complex because you have to take care of the two elements, the debt and equity. You have to analyze and then accordingly that you have to take these two composition. Potential for dilution. If your hybrids are converted into the equity share equities, then definitely the existing shareholders, they will get a fear of being diluted. Means they have to sell their part of the ownership to the new shareholders. They have to give their part of the ownership. So this will make the existing shareholders a fear in their minds. So there is potential for dilution. That is, if hybrids are converted into equity, the existing shareholders may experience what dilution, and it will directly or indirectly they will impact their ownership stakes. Then market risk, because we know that these market these like hybrid securities, okay, the warrants, the debt, the equity, the bonds, so these are very sensitive. Okay, so we don't know, the market is very uncertain. We don't know what will happen in the coming scenario. So there are market fluctuations also. Sometimes interest rate will make a remarkable change. The financial health will disturb. So it is happen that market, there is a market risk. So market volatility will be more. And calculation on these returns are not very easy because it is a composition of various elements. It becomes a bit difficult for them to make a proper assessment, to make a proper evaluation of the business. Clear? So, what are the types of hybrid securities? The preference shares, the debts and bonds, which can be converted into equity shares later. So, they are known as convertible debts or convertible bonds. Warrants, Mezzanine financing, and FCCB, foreign currency convertible bonds. Now, what is preference shares? We know that preference shares are a type of shares who are given a preference, means they have given a preference. When company earns a profit, okay, earnings after tax comes like 10 lakh rupees. Clear? Or profit after tax. You have seen the statement, income statement. Once again, I will show you over here. Is if we deduct variable cost, we will get the contribution. Then fixed cost, we will get EBIT. Less interest, we will be getting EBT. Then tax, EAT or PAT. So this EAT and PAT, this is first given to preference shareholders, the profit. Then whatever is left, then the equity shareholders, it will be divided among equity shareholders. So first preference is given to whom? The preference shareholders. Clear? So preference shareholders are given a first preference, that is they are being provided a dividend. Firstly, they are being provided a dividend after setting of all the liabilities. Whatever profit left, the dividend is first given to them, and their their interest of dividend is fixed. Okay. If it is decided that it is given 10%, then if the company earns 10 lakh rupees, still they have to give 10%. If the company earns 50 lakh rupees, still they have to give 10%. If a company incurs loss also, still they have to pay 10%. So this is fixed for preference shareholders. Clear? They are given a negligible voting right. You can say no voting right. Okay. And one more thing, when the company gets liquidated, As the name suggests, the holder gets a preference with respect to dividend as well as payment in case of liquidation. If liquidation occurs, so firstly they will be provided dividend, then whatever the amount is remaining, the equity shareholders will get. Clear? Hmm. Tell me, any doubt, anyone till now? Okay, let's move forward now. So it has several key features. The preference has been given to them, dividend preference. Liquidation, after company gets liquidated, okay, first preference have been given to them. Convertibility, they can be converted into equity shares holder at a specified ratio at a specified time. Okay, they have given no voting rights, limited or say no voting rights. Then redemption rights. Some preference shares may be redeemable. Okay, the time period should be mentioned over here. Ki when the company can buy back the shares, the time period is mentioned. And some will have it irredeemable. Means the time period is not mentioned over there. But when the company gets liquidated, then only the company can buy the shares back. And they have a fixed maturity, that is fixed maturity date at which point the company must redeem them. Clear? So there are cumulative, non-cumulative. All these things I have make you clear in my previous classes. Means in the before the day before marathon, or I guess yesterday only. Yes, in yesterday's marathon when we were completing module A and B. In B, I have made you clear all these things. So ask me if you have any doubt in any of the point. Hmm. Cumulative, non-cumulative, participating, non-participating on any of the preference shares. If you are having doubt, please ask me or else I will move forward. All these things we have already done yesterday. And please don't forget to like the video, okay, before leaving the session. Any doubt to anyone? All these in all these 8 or 9 points. Okay, let's move now. So yes, non-cumulative preference shares. Perpetual non-cumulative preference shares are what? Perpetual non-cumulative. So first we need to understand what is cumulative. Cumulative means suppose you have provided last year dividend was let's say 10,000 rupees. Present year dividend was is 10,000 rupees. But you have not claimed this dividend last year. So what happens in the present year, or in the present year you can carry forward this dividend. So this is what cumulative. You can cumulate all of your dividends in the present year. Non-cumulative, you cannot cumulate all of your dividends. That is non-cumulative. And perpetual means that will last long. Okay, everlasting. So perpetual non-cumulative preference shares, that is said as PNCPS, a type of equity security that has certain characteristics. They are perpetual. They don't have fixed maturity date. Non-cumulative preference shares I have told you. Okay. So PNCPS can be attractive option for investors looking for income without the risk of losing their investment. Okay, because because non-payment of dividend in any specific year, if they have not received any kind of dividend in the specific year, so there is very less chance, okay, without the risk of losing their investment, they can take the benefit of this option, that is perpetual non cumulative preference shares. Clear? So what are the things you need to look care of? This type of preference shares is issued by all the Indian banks as a part of tier 1 capital. The instrument should be issued by bank. Bank board will decide how much to raise. In capital, in additional Tier 1 capital, they cannot exceed 1.5% of RWA, risk weighted asset. Once the minimum total Tier 1 capital is met, and if any additional is being issued, so they cannot issue, okay, less than 2%. Means excess PNCPS can be considered under Tier 1 capital. Okay, it can't be exceed 1.5%. In Tier 2 capital, if uh, it can be considered Tier 2 capital if less than 2. So it should be what? It should be less than 2%. Means not more than 2%. It should be less than 2%. Clear of risk weighted asset. While meeting minimum total capital of 9% of minimum total capital of risk weighted is how much? 9%. So this criteria should not be over, it should not go over beyond this. Clear? These don't have any maturity rate, so this point is very important. Any doubt to anyone in this point? And the dividend can be fixed, okay, and can be fluctuating. Floating means fluctuating. Any doubt in this point? Third means what the additional, okay, these preference shares additional cannot be exceed 1.5% of RWA, you can say non-cumulative preference shares, okay. And if it is being exceed, then you have to fill under this Tier 2 capital, and it should be also less than 2%, not more than 2%. So they should not have a put option, means they are not given a put option. However, banks may issue instrument with a call option. Means bank may call you, but you cannot go to the bank. You cannot go to the bank and ask your money. Bank may call you, and if they want, they can pay you, return your money back. Clear? The call option on the instrument is acceptable only after it has run for 5 years. Okay, when the PNCPS has run for 5 years, then only the call option is given to them. Otherwise, the bank also may not issue with this call option before 5 years. Exercise the call option. Bank must take the permission from the RBI. Okay, NRI, FII should invest up to 49 and 24%. Remember, in yesterday's class, I have told you the automatic route and government route for foreign direct investment, foreign direct and foreign portfolio investment. So this is same. Clear? Of the issue respectively, where each investor limit is 10%. Means FII's limit is how much? 10%. NRI limit is how much? 5%. Okay, they cannot go beyond this. And the principal of this instrument can only be repaid with the prior approval of whom? RBI. So FII and RRI can invest up to 49 and 20% of the issue, and where each investor, means this is the total value they can invest up to 49. This is the total NRI. See, S is written over here. Foreign institutional investors, okay, and non-resident NRI, non-resident Indians. Okay, S is given, means in totality they can invest only up to 49 and 24, where the each investor limit is how much? Only 10% in case of FII and 5% in case of NRI. Tell me, clear? So this is given the whole amount of FII and NRIs, whereas the individual percentage is given only 10 and 5. Just the double. Yes. So you have seen risk weighted asset, risk weighted asset. So what is risk weighted asset? Okay, means to manage the risk amount, the weighted should be there of the capital and of the asset. Risk weighted assets are a banking term that refers to a system that determines how much capital a bank needs to keep on hand to reduce the risk, to manage the risk of the country, to manage the risk of the bank of insolvency. Clear? How much capital a bank is holding into it. That is risk weighted asset. In short, we call it RWA. Clear? So this line is very that determines how much capital a bank needs to keep on hand to reduce the risk of uncertainty. Risk weighted asset, and sometimes the ratio is also we need to calculate. So risk weighted asset ratio. Clear? Now what are warrants? Again, in terms of finance. Okay, warrants are what? Contractual agreement where the holder is what? The one who is carrying a warrant is known as warrant holder. So holder is given the right. Only the right is given, not obligation. Right for what? To purchase the share, to sell the share of the issuing company. Clear? Of the company's share at a predetermined price or at a predetermined time also. The time is also mentioned. Clear? So warrants are financial instruments that give holder the right but not the obligation to purchase a company's stock at a specified price. And this specified price is known as strike price also. Yes, this is known as strike price. Clear? Or other name is exercise price. Two words have been given, strike price or exercise price. The price at which they can purchase a company's stock at a price which has been mentioned. So what are the features of warrant? They are given right to purchase. Okay, they have a proper expiration date also. It means in that date they have to exercise their right. Dilution. Okay, new shares are issued to them. So definitely the existing shareholders they have to dilute their ownership. Long term nature. It is transferability. Means warrants they can bought and sold in the secondary market, and if allowed these warrants can also be transferable to someone else. Okay, they are transferable. Non ownership, there is no such kind of ownership, that is why they are transferable. You have heard one word, the Negotiable Instrument Act. Negotiable means what? Transferable. The word negotiable means transferable. The one who is carrying the it becomes of that person. Suppose I have a 10 rupees note. So I am the owner of this 10 rupees note. If I am giving this 10 rupees note to some other person, okay, so this person will become the owner of that 10 rupees note. So it means it is transferable. Okay, no ownership right is written on that 10 rupee note. I am the owner or he is the owner. The one who is carrying that warrant, the one who is carrying that 10 rupees note, he is the owner. Clear? Okay. Yeah. Now convertible debentures. Those debentures which can be converted into equity shares after a set determined time, those are known as convertible debentures. Okay, for till you debenture holders are what? The one who have been raised their shares, okay, issued their shares to the company. The company has purchased those shares, and instead of that, they are company are being giving regular interest to that debenture holder. So for some years, they are taking the benefit of interest, and if they want, they can become the convertible debentures. Means in the document it should be written that these debentures are convertible. That is, they might be converted into the equity shares later on. Clear? So it is a type of loan the company takes from investors. Loan, it is a convertible, means you can choose to convert your loan into shares of the company's stock after a few times. And interest payment, while you hold the debenture, you will get regular interest payment just like any other bond. Once you have converted your loan into company's equity share, you will be getting the dividend, and you also have to bear the risk factor. Here, any doubt? Tell me. Okay, chal. So Convertible debentures feature it is required the conversion premium as well as the conversion in the prospectus it is being mentioned. Okay, they can be convert into the premium, they can be convert into the equity. If the conversion takes place at or after 18 months, means after 18 months, but before 66 months. Okay, from the date of allotment, then only they can convert all those things. If the conversion take place, then only they can given the permission. Unless conversion duration is made optional with put and call options, a conversion term that is longer than 36 months means after 36 months it will no longer be approved unless the conversion duration is made a put or call option. If the fully convertible debentures have a conversion time that is longer than 18 months, okay, they need to they need to claim or they need to get the requirement of credit rating. Means a credit rating should be done if they are converting after a period of 18 months or more than that. Okay, they have a conversion time. So they need to file for a rating. Means a proper rating should be there so that the rating team, the rating authority, they can tell that this credit rating determines what the you have learned the CIBIL score. Okay, so they will determine the rating that whether this is good, whether this is bad. Clear? Tell me. If the conversion is taking place after 18 months but before 36 months, then it is good. If it is taking more than 36 months, okay, so it will not be approved. You need to make the option of, you need to fulfill the option of put and call options. Okay. If it is more than 18 months, the conversion time is more than 18 months, okay, you have to mandatory, you have to go for a credit rating. Then only it will work. I guess all these 4 points are clear to you all. Can we move forward now? Now, what are the difference between warrants and convertibles? They are short term. Okay. In some book, it will be written a long term, but in some book, it will be written short term. Okay. So these are not for a very short period of time. These are not for a very long period of time. Okay. These are in between short term to long term. These are long term investment. Again, the price is fixed, the price is not fixed. They can be traded separately because the warrant means it is a contractual agreement, okay, where right is only given. Okay, you can't go and you can't you have no obligation, you have no responsibility. If you wish, then only you can go and exercise them. So these are the few you can say differences between warrants and convertible debentures or convertible bonds. So everything which is be convertible. So for convertible, we need conversion ratio and conversion price. So ratio and price are both terms that are related to convertible securities. Okay, so conversion ratio is what it describes that the number of common shares, okay, a bondholder receives when they want to convert into a any kind of convertible security. The number of shares they are receiving in order to convert into a security, that ratio determines what conversion ratio. It is divided by calculating the convertible security par value. So any convertible security will be given if convertible debt will be written, then convertible debt, then debt par value will be there. If bond will be written, then bond par value will be there. Okay, by the conversion price. So conversion ratio will come. Conversion ratio is equal to any convertible par value upon conversion price. Clear? Tell me. And if we have to find out the conversion price, then how? The par value upon conversion ratio. Clear? So this is with the help of the simple maths, you can find the value of conversion ratio also, conversion price also, if you know any one of the formulas. So what is conversion price? That is the price at which convertible bond can be converted into shares. The price means, suppose your one bond is converted into the equity shares. The value of one bond is, let's say, 10. Okay. You need to convert your 10 bonds. Now, how much you have to pay in order to convert into shares? You have to pay 100 rupees in order to convert it into shares. So this is conversion price. Clear? And conversion ratio, if it says 20 is to 1, means one bond can be converted into 20 shares. If it is 40 is to 8, means 8 bonds can be converted into 40 shares. 40 is to 1 means the one bond can be converted into 40 shares. Clear this formula? Okay, I'm turning off the camera. Just look at the formula, which I have written. And please, everybody, please, if you feel it is helpful to you in any way, then you can like my session. Yesterday, I brought a lot of practical questions. I thought you will be giving me answers, but nobody gave me answers yesterday. So today, I have not come up with any practical question. There are only one or two practical questions related to conversion ratio. Rest in module D, you are not getting any kind of practical questions. The theory part is more. Now, tell me, should I move forward now? Okay, so let's see some more points related to the conversion ratios and conversion prices. Okay, so conversion ratio and the its date are set by the company when the original bond has been issued. It is specified in the formal agreement because it is a type of formal agreement. So everything will be determined between the issuer, the one who is issuing, and the investor who needs that money. Okay, the one who is going to invest in that certain project. Stock dividend split occurs. The conversion ratio goes up when the stock dividends and splits occur. These two occur. So conversion ratio will go up. And conversion price will go down. Means there will be inverse relation between conversion ratio, inverse relation between conversion ratio and conversion price. Clear? Now, what is mezzanine finance? Very important. Again, it is very important as well as very crucial. See what happens. Okay, suppose you have taken a loan on 1st January 2024. Okay, and with the intention that you will going to repay this loan after 2 years, means on 26, means for 2 years, for the duration of 2 years you have taken a loan. But in some case, for example, let's take you have taken a loan of 50 lakh rupees, but due to some bad circumstances came. Okay, you are not able to repay this loan on 1st January 2026 after 2 years. You have to repay this loan also 50 lakh plus the principal plus the interest amount, but you are not in a position to repay this loan. So what happens, the company says that okay, you cannot return my money back. Okay, so what you have to do is you have to transfer your ownership into my equity shares. Okay, now you can, if you have done this kind of default, okay, you can convert your debt into equity. So this the transformation from debt to equity is what this is provided under Mezzanine finance. Clear? So if it is transformed under into equity shares, then definitely you have to bear the risk of the company also, because these equity shareholders, if they are the owners of the company, they bear profit also, they bear risk also. So now you have to bear the risk as well as. So Mezzanine finance, it is a crucial component of corporate financing, okay, particularly for companies looking for growth. It is a type of funding that occurs between the debt and equity. Again, a hybrid type of debt and equity that gives the lender to right. Means the company will give the right to convert your debt into equity shares in case of the default which you have made. It is often an unsecured debt because no security you have given. Without security, you have taken the debt, and it typically matures in more than 5 years. Okay, so these are the points related to Mezzanine finance, and the most important point is third point. It is most important. Clear? Understood? Mezzanine finance. Now, now the second unit is of startup finance. Okay, we have completed our first unit of module D, the hybrid finance. Now six modules are left. The second one is what? Startup finance. So what is startup finance? A startup is a newly established scalable business. Means the business which is a scalable, the business model which has a growth, which has the potential to grow, which has the potential to expand. Okay, typically in the early stages of the development. So these are often characterized by the innovation, by the scalability, and if they have a potential growth, if they have a potential to grow grow rapidly, then these startups will called a proper innovative business. So startup often rely on funding from angel investors. These angel investors, they provide funding at a very initial stage. The crowdfunding, okay, all these things we will be learning in our later on slides. Crowdfunding is what? When you arrange funds from your relatives, from your friends, from your colleagues, from your peer members, that is crowdfunding. Under the Department of Promotion of Industry and Internal Trade, startup was established. So under this authority, under this department for promotion of industry and internal trade, that is DPIIT, startup was established to handle new businesses. The Startup India Hub, it is an online portal that offers a variety of services. Launched the project in April 16, and the government introduced which initiative for this? Startup India initiative. Here, okay, let's move now. Startup definition in India. Initial means before it was the definition, that is up to 5 years from the date of its incorporation. If you have worked for 5 years from your registration, then only you can be termed as startup. If its turnover for any of the financial year has not exceeded rupees 25 crore, then and it works towards innovation. So this was the definition of the initial term. But the expanded definition is what? Now the 5 years has been changed to 10 years. 25 crores value have been changed to 100 crore, and this is same. So what are the challenges? Sometimes new business they get failed to plan properly. Okay, they had expected well very unrealistic assumptions they have made, so the expectations did not work them. There's a gap of knowledge and skill. They don't have proper knowledge, proper skill. Okay, the time management and productivity. There is no leader in this group. You are the only leader. So the guidance, there is a lack of guidance. Cyber security, the data theft are such thing happens in the new business. Then you have to win the heart of your customers. That is the loyalty of the customers should be there. Only then your startup can go work well. Funding, competition, all these are what challenges faced by start. Now, before going for before going to the investor, okay, for asking the funds, for asking the finance, you need to present a pitch, just like in the Shark Tank you have seen. There, all the investors, okay, they are the investors who sit on their chair. Okay, they wait for the persons who come, they show their pitch presentation, and if the investors feel that okay, I can invest in such type of business, this is a scalable business, okay, if they get impressed from that business model, then only they will invest. So for pitch presentation, it should be a presentation should be short, simple, precise manner. Okay, the problem statement should be mentioned, the issues faced by the business society, what uh, problem are you are going to solve with this business model, solution to solve the issue, then show your business model, what technology you are using in that business model, what activity you are using. Is it's not that you are impacting any kind of commercial activity, business activity. Have you seen there's competition in the market of your same business model, so how you will going to compete with them? The What is your team? How many members are there in the team? What is the ratio of your team? Who is the CEO? Who is the CTO? What are the predictions that you have made for your future analysis, future prospects? Present status is what of your company? Then after that, they will see the summary and then they will make a proper call. Okay, proper action they will going to take. And if you agree on their action, so it is your final call whether you want to accept their offer or you want to ignore their offer. So this is how the one who comes who has to present a pitch in this way. There, so there are certain programs and competitions. Okay, so these are few programs. Okay, read it. Few programs, the startup yatra, the bankruptcy code. Okay, they will grant the loans for proper R&D, for making your product making your product more scalable. Okay, they will provide, they will improvise your skills. So different programs are there so that they will help you in any manner. The Ministry of New and Renewable Resources offers a kind of approach for this innovative businesses. For innovative zones are there, different zones where the innovation, new ideas will be provided to your company. Okay, state startup ranking will be there. Different people from different states, they will come with their startup. They will showcase their skill. Okay, accordingly that they will provided the rank. Demo will be there. Then any product related to animal husbandry, the challenge will be there. They will grant you loan. Ayushman Yojana Startup Grant Challenge. Then any product related to textile innovation challenge and MNRA Startup Grant Challenge. So these are the various challenges. Okay, you have to go for these challenges. The rank will be provided to you, and if you successfully you have fulfilled these challenges, they will provide you grant. Clear? Now single startup use plastic challenge. Okay, the following benefit will be made available through this program. So guidance will be provided to you. Grant funding they will give you for 10 pilot projects. Means actual project, your actual startup, your actual business model is not going to launch in the uh, uh, it's not launching. They will only provide funding for your experimentation, for your pilot study. Then exhibition will be there of the impact of successful pilot projects. Okay, establishing professional contacts. They will provide you, they will help you, they will tell you that you can contact this professional team, they will help you. Okay, seminars and presentations will be, they will conduct seminar and presentation. An opportunity for a pilot project if and be partners in Goa Research Park. So if your business model is scalable, if your business model is that which can expand, which have a growth, okay, which can help the society and customers, okay, the people can understand your problem statement. If your model consists all these things, then the government will also help you, because government is helping in the startups now. So they are helping different types of programs with different types of models. Okay, they are granting you, they are helping you, they are providing you different improvised measures. You can improve and you can perform well. For R&D, because most of the expenses, more expenditure occurs in this R&D programs, for research and development, for pilot study, for experimentation. Clear? Now, research park, as of May 2021, the following 8 new research parks has been established. This you have to keep in mind. IIT Delhi, Kanpur, Gandhinagar, Mumbai, Guwahati, Kharagpur, Hyderabad, and one is IISc Bangalore, Institute of Information and Science Bangalore. Okay, 8 new research park. Context of a start typically refers to a streamlined process for users to register or sign up. Okay, they don't have to go for long, stringent rules, stringent actions they have to take place. No, just only one single point registration scheme is there. They can fill that form, okay, and they can register through a single platform or interface rather than going to multiple platforms. So, what are the key features for this? A unified interface is there that will collect all the necessary information data, okay, regarding the startups company. Then cross platform compatibility, it is accessible, means anybody can access from the mobile phone also, from the you can say monitor also, from web also. Integration with other services, so often allows what users to sign up using existing account, means you can use a Google account also, you can use a Facebook account also. Okay, like if you have whenever you download any kind of app, they will ask you that sign in from which, Facebook, Google, okay, which option they will give you, they will provide you 2 3 options. Now it entirely depends on you that which option you will choose. Data management, they will centralize all of your data in one site. Okay, so it is easier for startups to manage that information properly. Now, what are the tax exemptions that has been provided to these startups? Okay, section 52, subsection 2, subsection 7b. Subscription of shares of a closely held company at a value that is higher than the market value of the shares of such company. So for them, section 56, there's a tax exemption on the basis of self declaration. Startups have been granted this exemption under the Income Tax Act, that they for the whatever shares they will issue at a price higher than the price that is prevailing in the market. If their price is higher than the price which is prevailing in the market, they have been granted a tax exemption under this section 56, subsection 2, subsection 7b. Important. Here, ESOPS. Okay, it is basically related to double taxation. See, there are many startups. Okay, they have been opened their company in foreign also. Now they are Indian member, they are Indian resident, and they have opened their company, their new startup in the foreign. So what happened with this? They have to pay double tax. Okay, so now for this they have to sign DTA. Okay, DTA is that double tax avoidance agreement. Okay, so this is basically that ESOPs are basically subject to what? Double taxation. Okay, by delaying the payment of tax for a period of 5 years means for a period of 5 years you can still wait to pay your taxes. They will give you a grace period, that is period of 5 years. Clear? What is ESOPs? Employer stock. What is next? Tell me. Employee stock. ESOPs. Employee stock. O stands for option plan scheme. Okay, so this is the full form of ESOPs. Now, under Section 80 IAC, the turnover criteria for eligible startups have been increased from 100 to 20, from 25 to 100 crore. This was the initial value, and this was the expanded value. So it comes under 80 Section 80 IAC. 54 GB Hindu undivided family, they will be excused from paying tax on the capital gains. If any capital gains occurs with this Hindu undivided family business, so they can get the exemption under this section 54 GB. Clear? Done. Now, selection of startups. Okay. Any doubt before this? Wait, can we go? Now, selection of startups. How we will going to select the startups? So, member of the following groups will make up the ISMC. Okay, can anybody tell me what is ISMC? Hmm. ISMC, Incubator Seed Management Committee. So, who are these incubators? These incubators are, they will guide you, help you in the startups, in the early stages startup companies. So, they will provide you all the experience, they will provide you all the guidance, help you in any way out. Clear? So, first of all, representative from the central government startup nodal team. Okay. So, this will be the member representative of a venture capital or angel network, the nominee of the incubator, a domain expert from academics, two successful entrepreneurs, a domain expert from industry, and any other relevant stakeholder. So these are the members, okay, who will form a group to form the incubator seed management committee, and they will help and guide to every new startup. Okay, if they will guide them, then their selection may be good in the coming scenario. Means if any the programs which is being held, you have seen over here, this type of program, this type of challenge, so they will be get ready for overcoming these type of challenges. Now, types of startup, the debt. okay, that needs to repay over time the equity and the grant. That is non-repayable funds offered by whom? Government. So government will offer them grants, the foundations or organization to support specific project. And these project may be in the field of what? Technology, in the field of societal, that will create a positive impact. Now, the stages of startup and sources of funding. So first stage is idea phase, means the very basic level phase. The idea, only the idea has been generated of this product. Okay, I have an idea to launch this product, to make such kind of product in the market. Will it go? Will it not go? It I don't know. But I have just an idea. Okay, entrepreneur has the only business concept in their head and it is working to turn it to become a reality. So we don't know it will work or not. So for this, which type of fund we can use? We can use the crowdfunding. We can use the bootstrapping. Bootstrapping means what? Your self finance. Okay. Your own money, your personal money. And crowdfunding means in the starting only I have told you that when you arrange funds from your family, from your relatives, that is crowdfunding. Seed stage means the idea has been made, the product has been also made, but the product is has not been launched in the market. We are doing the proper testing, the trials of this product. Once the product is being liked by many people, then we can launch this product in the market. So this is seed stage. Company is required to carry out field trials for test the product on selected number of clients. And if they agree on this, if they say yes, product is good, nice, if this product work on them, then only they will uh, then only they will what launch their product in the market. So for seed stage funding, okay, who will provide the funding? Mainly the crowd funding. Okay, you will get the help from such funding. But the idea phase funding, the mostly funding you have to use is from the bootstrapping. Crowd funding comes a bit later, but the initial it comes from bootstrapping. Crowd funding comes in the seed stage or a later idea phase stage. Clear? Angel investors are private individuals that put their money into high network individuals. At this point, it is possible to raise funds through a network called crowdfunding. Clear? Now, Series A stage means in this stage, a product is being more okay, it has been launched. So, monies are being raised so that company can develop its user base. Funding for these late stage firms comes from venture capital or private equity. After that, these venture capital, they will provide you finance, they will help you. Okay. Then what happens? It is possible that the investors will come to the conclusion that either they want to sell the portfolio from to another company or they just want to work in your company. So in this way, they can take the exit option. If they will sell your portfolio to another company and in such way, they can take a exit mode. So they only enter in such kind of funds, in such kind of private company who has the chance to give a exit option. These venture capitalists. Then only they will enter in such companies. Clear? Now, funding scheme and programs. Okay. So SIDBI, funds of fund scheme, SIDBI will provide the funds, the regulations. The government of India established a fund with total value of 10 crore and with the goal of increasing the available capital. Credit Guarantee Corpus will be of rupees 500 crore per year. Okay, so for this, if the investment is provided, then they can foster the expansion. Okay, they can grow their Indian startup ecosystem. Startup India Seed Fund Scheme. This is giving how much? This is estimating rupees 945 crore to provide funding to startups for POC, that proof of concept. Yes, you have the product, you will make this product a very big product and it will launch in the market. It will give you a more job. It will give you a more prototype. Okay. The product trials for prototype development means for the proof of concept, for the early stages, for the product trials, this startup seed fund scheme will give estimate how much 945 crore. They will provide funding to related to commercialization for market entry. Startup India Global Venture. Okay. So DPIIA, this is mainly okay mobilizing for global capital innovation in India. Venture capital assistance scheme. Okay, it is basically comes under what Ministry of Agriculture and Farmers Welfare. They if any project is related to the farmers welfare, okay, so they will provide monetary assistance in the form of interest free loan for agriculture and for farmer. So for agriculture, what type of loan? Okay, venture capitalists will provide interest free loan, because agriculture and farmers are the sectors that if uh, if they will grow, then only we will grow. Clear? So these are the basic sectors, the agriculture farmers. So for them, the development is very crucial step. Then SIP EIT. SIP EIT is what? It is a support for international patent, and EIT is Electronic Information Technology Program. So these two programs are run by the electronics department and IT department, and it basically provides the funds to small industries, to micro, small, means MSME, micro, small, and medium enterprises, so that they can, if they have any kind of international patents, so they can file that patent. So for such, for filing patent, we also need money. So for them, this kind of category, the this Ministry of Electronics and IT, they support for such kind of project. And Small Industries Development Bank of India, that is SIDBI, they provide arrangements for what? For SC, SC, and for women entrepreneurs from ranging from 10 lakhs to 1 crore to be given for one borrower belonging to the any kind of caste related to scheduled caste and scheduled tribe. Now, ADA and NCEF refinance scheme. Okay, it is basically assisted by the National Clean Energy Fund. If any development agency which is a project which is working for renewable energy development, any startup, so they will provide finance them. For biotechnology, if any type of startup is that who is working for biotechnology, then for bio innovation capital, the funds will be provided. Okay, technology development, for any kind of new technology is there, any startup is being made for the technology enhancement, so for them new funds can be provided. Yeah, so these are the programs and these are the categories for whom the funds they will raise, and the government will provide the funds so that they can grow faster and they can also expand. Clear? So yes, we have completed our startup finance also. Any doubt to anyone? Now next unit is what? Venture capitalist, venture capital and private equity. Any doubt to anyone? Tell me, I'm waiting for 1 minute. If you have any doubt, please do let me know. Okay, no doubt to anyone. Now let's start with the very new chapter, that is private equity and venture capital. So what is private equity? What is venture capital? Can anybody tell me what is private equity and venture capital? So venture capital, it is a type of private equity financing that is provided to early stages. Okay, high potential startups and small businesses. So venture capital, what it is made by the firms or individuals into startup. They will provide early stage financing, and they, in return of this, what they will take a part of your company. That is ownership of your company. Okay. So the goal is to provide funding to companies that have potential for significant growth, and that we will also generate high returns for the investors. So basically what venture capital they do, they join your company. Okay, they provide funds to your company. In return of that, they will ask ownership of your company. After providing funds, after working in your company, okay, making certain improvements in your company, the what type of improvement are required in that company, okay, improvise that company. After that, they sell a part, they sell that to the other company, okay, the company, and from that they will make a huge profit, they will make a huge return. Clear? Tell me. Now, so what are the key components of venture capital? They provide on a seed stage, okay, for idea development, we have seen in the startup just now, for early stages when the product has been made, when the prototype has been made, when it is going for the product trials, market testing, product trials, market testing, and for the growth stage. What are the investment process? Okay, they invest through their networks, through incubators, through pitch events. The proper negotiation is also happened in that cases. Okay, the negotiation will be done, the teams will be discussed, and they will only enter in such funds. They will only enter in those companies who are private companies and who give them a exit mode, because they also want to get exit from this company now, after earning from this company, so they can take the exit strategies with the help of IPO. Okay, means they will sell the shares. They will taking the company public to sell the shares to the other company. Then they can acquire your company. They can sell the company to another firm for acquisition and secondary sale. They might sell the shares of your company to other investors. So with the help of these three functions, these three ways, they can take a exit strategy. Either they can sell the company to another company, okay, they can sell the shares of your company to another company, or they can sell the shares to other investors. So why does VC exist? For providing funding, for supporting to early stages companies, for minimizing the risk and uncertainties, because they have worked in many different companies. So they are experienced holder. They know how to minimize the risk. Access to capital, many new startup, what happens, they cannot generate more and more profit. Okay, they cannot handle all the capital, the structure of the capital. So for this venture capitalist, they will improvise them. Okay, they will support them, they will provide necessary funds, okay, for the development of the product. Then they also provide mentorship, guidance, different types of innovative measures, so that they can also make their company grow. So overall, they play a crucial role. Now, what are the financing options that are available for the initial stages of development? They provide finance. They provide finance for growth and expansion, and for acquisition financing. Means if any company wants to purchase any other company, so they provide finance for the acquisition as well. Clear? So what are the procedures involved in obtaining venture capital funding? So first of all, the beginning of the transaction started. After that, they will screen your company. Okay, is your company will generate a large profit or not? Okay, after that, detailed evaluation will be done. Okay, the rating will be seen. They will see the rating of your company. Negotiation will be done between you and the owner of that company on the price factor. After that, post investment related activities means after the all the things have been done, then who will be getting what kind of portion, what kind of ownership, and then they take a exit plan. Clear? So this is how they enter a firm. Okay, they enter a firm, they sell the shares of the firm, and then with that selling, they earn a profit and they take a exit mode, exit plan. Again, few advantages and disadvantages. They can access the capital, they provide expertise and guidance, growth, network opportunities because they have worked with many networks. So they can provide valuable connections to potential partners also, to your customers also, to your clients also, to future investors as. There's equity dilution because if we'll take a ownership of the company, so this ownership, if they will take, so the existing shareholders has to dilute their part, their ownership. Then only this person will get the ownership. So there is pressure to perform because they are taking a high returns from the company. So definitely they will have a pressure to perform well. Loss of control. If we say involved in such kind of business, so they will take the decisions. Okay, they will have decision making power. So sometimes what happens, the owners will get scared. My decisions are taken and that person is taking my decision, my what in direction I was going, the different direction he is going. Okay, he is taking the company, so there is fear of loss of control. Then conflict may also arise. And the disadvantage is that venture capital before entering, they expect a exit expectation, that how I can take a exit from this company. I can take exit with the help of IPO. Okay, I can sell the shares in the public listed company, or with the acquisition, I can take a exit. So within few years, they have to take a exit. So 5 to 6 years they work in a company and then they take a exit move. Roles at VC, they arrange capital, they invest in that company, they help the company to grow and expand, and then finally they take a exit. What are the prospect of VC in near future? Means companies and funds, they save their cash. Okay, stock valuation are brought back under control. So means in near future, what is the scope of VC? Prospect means what is the scope of VC in coming future. So they arrange funds for the company. Okay, the stock valuation, they if the valuation of the stock, they will make the valuation of the stock higher. So definitely the profit will also be higher. Okay, uh, uh, coming scenarios, the production of batteries will going to have a very eventful year. Means everything is working on a battery nowadays. So they will work on this scenario. Business are more developed and they have a better access because of new technology. Okay, the market for VC is becoming more decentralized. Means the risk is being diversified, decision making power is being delegated to every person. So it is being scattered somehow. Biotechnology and medical startup, okay, they are playing a very crucial role in this field, in the startup field. So more and more funds should be provided in such field. The values of customer will definitely, they will impact the evolution of business. Okay, if customers are happy, then definitely they will purchase again and again the same product. Okay, if we are not providing the satisfaction to customers, then we are losing our customers, we are losing the customer loyalty. Clear? Now, what is private equity? Okay. Again, private equity are what? These are also just like your venture capitalists. They acquire equity ownership in private companies, and they also do the same thing. They provide they provide funds to the private companies. In return of that, they ask for the equity ownership. They provide funds typically to high network individuals, those who have a potential to grow faster. They provide funds in such companies. Okay, those companies have a benchmark, have their own standard. After a period of growth and value enhancement, they also take a exit their investment. So more or less, private equity and venture capitalists are lump sum. They both are same. Venture capitalists, they provide funding at the initial level of stages, whereas private equity, they provide funding to a more you can say more high level of business who has maintained their position in the economy. Here now, investment in private equity, the venture capitalist, growth equity. There are buyouts, means if one party acquires the control of another party, it means they are purchasing another party, another company, okay, control of another company. So the control should be more than 50 control, that is, it should be 51, at least 51. And distressed assets, those assets which are not performing well, those assets which are giving a negative impact in the business. So they help in such kind of things. Now, advantages, high potential returns they ask for. They give funds to private companies. Their control is more as compared to venture capitalists. The active management should be there. Okay, they can influence the business and they can also involve everything in the business. Tax benefit are being provided to them. Diversification, the risk, everything will be diversified, and they have a good expertise and resources. Some drawbacks, they ask for high fees, their risk is more. If the returns are more, definitely risk will also be more. Conflict will be more because they take majority of the decision of the company. So there may be conflict as well as lack of liquidity, then lack of diversification. And due diligence means they need to look every ins and outs of the company. Okay, the company should act in a proper manner. Everything should be transparent. No hidden data should be there. The information should not disclose. The customer's information should be hidden. So everything should be in a proper manner. That is in a due diligence. Tell me, any doubt to anyone? Now, next topic is what? Leveraged buyout. This I have told you before also, means borrowing a loan and buying a company, that is leveraged buyout. Okay, taking a loan to buy a target company. After once you have bought the target company, you will repay the loan with its share. Okay, you will repay the bank loan and then you will then again you will sell this company and you will make profit. Means firstly this acquirer, they will take a loan to buy this target company. Once the target company, he has purchased the target company, so this acquirer will use all the revenue of the target company to pay the loan. Once the loan has been repaid, then he will sell this target company to the other company and they will earn a high profit. So this is what LBO is. Clear? And similarly, private equity, how they works, these are the investors. Okay. They invest in private companies. After investing, okay, they invest in countries, in companies that are struggling, but they have high potential. Okay, if they have high potential, then definitely they will generate huge profit. Okay, they will improve, these investors will improve the profitability of these companies. And once the profitability has been improved, okay, they will again earn a huge amount, and with this huge amount, this company, they will sell it for a higher price. Means improvements they will do in such companies, and after that they will sell the companies to the another one, and they will sell for higher price. Now, some legal and administrative structure of India. So under the SEBI regulation, okay, so what are there are different categories, okay, and these categories are introduced by the SEBI, Securities Exchange Board of India. For what purpose these categories has been, you can say, introduced? For increasing the accountability of the participants of the market and for market stability. So they have been launched three categories: one, two, and three. So in one category, venture capital funds are included, including angel funds, small medium enterprise funds, social venture funds, and infrastructure funds. The four funds you need to learn: category 2 and category 3 alternate investment funds. So in first category you have seen social venture or SMEs or infrastructure or other sectors which will provide benefit to socially desirable projects and economy desirable projects. In category 2, so those who do not fall in category 1, okay, they fall in category 2 other than to meet day-to-day operational requirements. In category 3, what happens? It may employ leverages including through investment. So various types of funds what are provided under these two categories are hedge funds, pipe funds. So these are registered under category 3. So all these things you need to cram. Now, angel funds are what? Angel funds is a subcategory of venture capital funds. So they provide funding to those who have a very early business. Okay, they provide funds to those who have a very early business by way of units to angel investors. So a high net worth individual who provides financial backing for small startups or entrepreneurs, and typically in exchange for ownership equity in the company. So these angel investors, they provide funds to early stages of business. They are a part of what venture capitalists. Subcategory of venture capitalist fund. So this is how they provide seed funding to entrepreneur, and they take a portion of ownership of equity. Angel investors they take. Now, what are the crucial stages in the process of investing in private equity? First of all, means the important stages that are included in the process of investing. Where investing in private equity. So what you need to do first? First, you have to send a type of teaser to your a teaser by investment bankers. These are investment bankers. They will send a type of teaser of your business. Okay, this is the working condition. This is the people. All these things are working. So a type of teaser will be sent by investment bankers. There should be non-disclosure agreement. Okay, then memorandum should be there every regarding every confidential information. It should be provided. Valuations of the company, what interest you have. Okay, expression of interest, what interest you have, that you need to show them. You have to give the permission to access all the data. They can access your data, they can see if everything is fine, then only they will provide funds in your business. Management of meetings should be conducted. Then formal notice of intent should be given to them, and at last the contract should be made for the purchase of the shares of the particular company. So this private equity, so all these stages are included when we have to invest in private equity. Financial due diligence. Again, it is a process of what? Analyzing, assessing a company or investment opportunity before making any kind of investment decision. So everything we need to analyze about the company, its strength, its weakness, its opportunity, its threat. Okay, everything we need to analyze before making any kind of investment. Once the decision has been made, we can't reverse that decision. So it ensures that they have accurate and reliable information about the company's investment. And it with this it helps to develop a trust between investors and founders. An overview of the company being targeted. So financial matters, the corporate, the people working in that company, that matters. The relationship between the sales customer, it matters. What contracts they have made with the previous companies, that matters. Any issues related to employee, any issues related to the management, that also we need to look that also. Litigation, what are the legal laws? Are they following all the laws, all the compliances, rules and regulation? Tax is there. It's not that they are avoiding the tax. Okay. IPR, intangible assets, it also matters. And the transaction involving with the any other related parties means if you have your transactions with any of the parties, which is your internal party, which is your external party, you also need to disclose that. Clear? And this is how they take an exit strategy. So, what is exit strategy? It is a plan that outlines how an investor intends to sell or liquidate their investment in a business. So with high profit, they will earn a high profit with this exit strategy. So then only they will enter in a particular firm in a private firm, they will provide funds. Because if they are providing funds in a large amount, then definitely they will also take a large ownership of that company. And after that, all the shares they will distribute, they will sell the shares and then they will make a huge profit. So with the IPO, with trade sale, with secondary buyout, okay, procedure with two separate tracks and recapitalization through the use of leverage. So what is IPO? That is initial public offer. So what is initial public offering? Can anybody tell me? Several times this word has been come. Initial public offering means what? When it is such kind of you can say a offer when a private company, okay, when any private company they sell the shares of the shares or stocks to the public for the first time. Means that the company which is listed on the stock exchange, they sell the shares of the company for the first time. Then that is called initial public offer. Now, second is what? Trade sale. So trade sale, what? It is a business transaction where a company is sold to another business. And when this company is sold to another business, it is to be take care that the business should be work in the same industry. Means a food company, one food company is being sold to another company, so that another company should also be working in the same industry, that is in the food industry. Now, what is secondary buyout? So it is a financial transaction where a private equity where a private equity firm sells its majority of share in another company, and that another company is what? Another PE company. It should be PE firm. So that is secondary buyout. Here, proper methods should be made when there are two entirely different tracks, different industries. The recapitalization through the use of leverage, that is through the use of borrowed capital. And what is borrowed capital? The loan, the debt. It should be done recapitalization for that. Tell me, we have completed our third unit of module D. Any doubt to anyone? Chalo, let's move to the next topic, that is AI, artificial intelligence. Okay. Now, so what is artificial intelligence? It is the ability of computers or machines to perform any task that replicate human intelligence. Clear? So they this includes things that human can, whatever human can understand, they can also understand. They recognize the same pattern for some problem solving. So it includes machine learning, NLP, robotics, computer vision, and others. So we can't say only the robotic is AI. No, AI, robotics is a part of AI. AI includes many different categories, machine learning also, NLP, CNN, computer vision, everything. So see, the big is artificial intelligence. This is a big box. Under artificial intelligence, machine learning is, deep learning is, neural networks is. So neural networks, they also act just like your nerves of the brain. As your nerves are connected with different nodes, similarly neural networks, they are also connected with different nodes, and these nodes help us to find the any output, any answers regarding the data what you have provided to them. Clear? So what is history of AI? The Alan Turing, okay, he is the mathematician from the United Kingdom, and he is credited with being the first person to suggest the machine is intelligent. John McCarthy, a professor at Institute of Technology, he is being coined the term artificial intelligence in 1956. So this is the history of AI. 1950, it all started. McCarthy coined the term computers become faster in the year 1994, 1974, 1980, the emergence of AI, and in 2000, the landmark of AI establishment achieved. Now, where is the applicability of AI in healthcare, in finance sector, retail sector, manufacturing sector? Then in transport, education, entertainment, NLP. Okay, NLP, it includes AI powered chatbots. We have seen the chatbots in Telegram also. Virtual assistants like Siri, translation services, better human interaction. Smart cities for R&D. This is the most important phase where AI is used. What contribution Google has given in the field of AI for R&D, for NLP? Google has pioneered developments in language processing like BERT, T5, then Google Assistant like Siri, image and video analytics. AI Hub. So AI Hub is what? means where you will find everything related to AI. Okay. It is a platform or ecosystem that fosters collaboration, innovation, development in the field of AI. So these hubs will include everything, every resources, tools that will support AI. Resources, access to data sets, software tools for AI, then networking, opportunities to connect with researchers in the field of education, for collaboration, for different AI projects, for research, for R&D, for any kind of new startups are there, then R&D is used a lot. Okay, for pilot study. So AI aims to accelerate the growth and application of all the technologies that is related to AI. Now, AI in banking and finance, it reduces risk, it improves the customer experiences, okay, it enhances efficiency with the help of chatbot, robo advice, predictive analytics, okay. We can make the predictions for the future outcome, we can forecast it, cyber security, the data security, and scoring credit and direct lending for customers as well. So these are the features that help in the format of in the you can say in the field of AI in banking and finance. AI helps in banking and finance in all of these ways. Now, what is predictive analytics? It is the process of using data to forecast what future outcomes. That is, we do predictions. The predictions we do in our business organization, the same we do it over here also. The process uses data analysis, machine learning, okay, that help us to predict our future behavior, and statistical models to find patterns that might predict the future behavior of the particular thing. So AI intelligence can be applied to every field, be it psychology, be it biology, neuron science, sociology. In every field, AI is important. And it also plays a vital role in all these fields. So what is the future of AI for transportation? We need AI for manufacturing purposes, for education, and for customer services that is mainly used in banking and finance. What is neural networks? I have told you, just like our brain, which have many different nerves, they are connected to each other with different nodes. So neural networks are a fundamental component of AI, particularly in the field of machine learning. Okay, as human brain processes its function in the same way, this neural network they also process their function. They comprises of neurons. Okay, the basic unit of a neural network, you only need to learn this neurons layers. They have three layers. Input layer, the input layer, they will receive the data. The hidden layer, they will process the data, and the output layer, they will give you the desired result. Clear? And weights and biases. If you will give the biased data, then the result will also be biased. If you will give a proper weights to them, okay, proper data, then there will be connection, there will be the result will be, you can say, impartial result will be there. So each connection between neurons has an associated weight. So all these things don't you need to go in this. Okay. Just remember the structure, neurons, layers, and weights. And in layers, there are three layers: input, hidden, and output. Now, what are the tools and techniques of artificial intelligence? The search and optimization heuristics. They are a type of search methodology that can be used to remove some options. A proper logic should be there. This logic for why we are using this kind of technology in our business. Okay, there should be proper logic. And probabilistic method means we are if we are making just an assumptions, if we don't know that whether these assumptions will be proved to be correct or wrong, so For the making this clarity, we use AI. And for different mathematical and statistical methods also. Okay, so these are the tools uh, which uh, which are used in AI. With the help of these tools, okay, anything can happen anytime. Search and optimization. Search in AI and optimization in AI. So what is search and optimization? So search in AI, it involves exploring, okay, finding the solutions related to any kind of problems, finding the solutions to resolve the problem, to resolve the problems. Optimization. Optimization is what finding the best solution from a set of possible solutions. So different solutions will be given to you. Now you have to find the best solution. That is, you have to find best alternatives among the following alternatives. Like this, understand. Okay, best alternatives you have to choose from various alternatives. Here, probabilistic method. Okay, for uncertain reasoning in AI, it is essential for handling uncertainty and making decisions based on any incomplete data, any incomplete information. Now, what is AI and morality? Means the moral values, the ethics. So, first is for decision making. For decision making process, we need to follow all the moral values. AI systems are increasing involved in decision making processes from healthcare to criminal justice. There should be biasness and fairness. Okay. Autonomy, it is independent. It becomes more autonomous when ethical questions arise for their decision making capability, especially in the environments like military and vehicles. Privacy, okay, the data which should be provided, because AI contains a lot of data, means infinite number of data. So all the data, they often rely on vast amount of data AI technologies. So we need to take care that everything should be private. Okay, the user privacy, we should maintain that. And without their consent, mm, we should not transfer any kind of data. And job displacement. With the invention of AI, what happens? Many people have lost their jobs because everything is being automated. So it is the duty of the government, it is the duty of the company, the one who have lost their job, okay, with the through AI, through the invention through AI. So they should support them, those displaced workers. So this is the moral values, the proper ethics that we need to follow. And what is the societal impact? The trust of the public. Okay. Because many public, they feel they are very scared in adapting this AI. So it is essential for their adoption also. Global equity and human AI collaboration means the AI, ethical AI, it involves the collaboration between the humans and machines. That is humans plus machines. Clear? This AI. We have completed AI. Now let's have a break for 10 minutes more. After that, in a flow, we will complete our last three units. One is SPAC, one is business analytics, and another is sustainable financing. Okay, so we will complete all these three topics before 12 p.m. Okay, so let's have a break for 10 minutes. Please tell me, everybody, am I audible? Okay, so we have completed our many of the units of module D. Now only last three units are left. First is SPAC, then business analytics and sustainable financing. So let's complete all these three units. Clear? Just a minute. Chalo, let's start now. What is business analytics? Okay, see, you have done everything. You have done hybrid finance. Okay, that's then we have seen what how the private ventures and venture capitalists they provide funds in our business. Then business analytics are what we need to. We have a lot of data for our business. Okay, lot of information is there as we have seen as information explosion. So now business analytics, what it says that what data we need to require for our business, we need to require for our organization, we have to analyze those data properly. So it refers to the combination of skills, technologies, and practices that are used to analyze the data. And with this data, the performance of the organization can also be measured. If the performance can also be measured, then we can make the proper decisions related to our business. The good decisions related to our business. So business analytics, it is a combination of various technologies, various skills, various information, various data, so that proper decision can be taken related to the organization. Clear? Mhm. Now, so first comes data mining. Data mining is what we have a lot of data. So in this lot of data, okay, we have numerous number of data. Now our organization needs what type of data we need to collect that means the requirement of data is needed for our organization. We cannot take all the data. Whatever is required for our organization, for our analytics, that data only we can take. Okay. If we will take whole data, then it will create a chaos, it will create a confusion. So what data we need to require, the usable data, then that data only we will take for our organization. By the year 1995, okay, first international conference of knowledge discovery and data was held in Montreal. It is a name of a place. The phrase data mining. ARI, this is the Association for Advancement of Artificial Intelligence. It hosted a what conference for the subsequent 3 years, and it was responsible for the conducting of this event. So you need to remember the place where it was held and the association agency. Only in this slide you need to remember the year, date, place, and the association agency. Clear? So, what are the essentials? What are the importance of business analytics? So, when it comes to commercial enterprises, means enterprise which is related in the trading purpose. When it comes to that, so business analytics is used for analyze data because data comes from a range of different sources. Now it becomes more complex for us ki which data we will choose. So we need to analyze the data. We need to relate what information our organization is, what goals of our organization is. Within that goals we need to collect those data set, and then we can use different methods, technologies to you can say train that data. Keep an eye on key performance indicators and the support decisions that is based on the most recently available fact types. The one is descriptive. Okay, they involves the historical data and KPI to discover the patterns and trends of our organization. Then diagnostic research, it explains that why it happened. Okay, suppose your organization in 2022 it made a profit of 10%. In 2023 it made a profit of 7%. In 2024 it made a profit of 5%. Okay, so you need to analyze that why your profits are decreasing every year. Okay, so this is what this is. This may be done, okay, with the help of diagnostic analytics. You need to find the reason beside this. Behind this, you need to find the reason. So that reason will be found with the help of diagnostic analytics. See why your profit is decreasing every year. It explains why it happened. Okay, so this type of analysis focuses on previous performance. Now, predictive analytics means now you have to make prediction for 25, 26. That if this is the scenario, then in coming years, what will happen? Time will come when there will be zero profit. So you need to predict properly, forecast, and if you will see that it is a zero profit, then you have to work hard on it. Then you have to make different improvements in your business. And prescriptive analytics. So this approach makes the use of data on previous performance to make any kind of recommendation for how the similar performance you can face in the future. Okay, how they can be, if such type of similar performance will occur in the future, what your actions will be. Okay, what your takes will be. So what are you going to take such kind of action when you will be going to face such kind of problem in the future? So this is prescriptive analytics. Here, these four analytics are very important. That's why I explained you with the help of an example. Here, everybody, hmm, tell me, can please give me a thumbs up if everything is clear to you. Okay. Now, what are the elements? Data mining, the process of discovering patterns, the relations, correlations means the relation between different variables. Text mining, again, uh, what is text mining? That many text is written. Okay, now you will only pick up those text which is useful for your organization. You will not going to take pick up the whole text. Data aggregation, that is, it is the process of what collecting all of your raw materials, and it these raw materials should be presented in a format, in a good format. Okay, that is data aggregation. Forecasting, and data visualization, you have to visualize your data, okay, in a form of pictorial, in a form of graphical representation. So data mining process, first data is to be collected, then it is to be prepared. So this is a lot of data. Okay, a lot of data is you have picked up this data, this data, this data. So this is what you have done, data mining. You have collected the data. Now you will prepare A data, B data, C data. Okay, the data mining process. First you will collect all the data. You will prepare the data. Okay, this is the data I select, this is the data I want to select, this is the data. Now you will select this data and you will keep aside the data mining process, and finally you will interpret okay, if you have chosen this data, is this data benefit for your organization, is this data giving you a good result in your organization? You need to check that. So data mining software and tools are there, these you need to learn. L, Alteryx, AWS, Databricks, Data Data Robot, okay, Google H2O.ai, IBM, NIME, Microsoft. So these are the software and tools which helps in data mining. Yeah. So what are the benefits? They increase productivity, they improve the quality also. With this, supply chain will also improve because now the data has been collected. Now a lot of data, suppose 10,000 data are there and you have made this data smaller to 1,000. So it will be easy for everyone also. There will be improvement in the management also. Production will also improve. Risk will manage. From 10,000 data, the risk will be more. Now only the 1,000 data is there availability, so risk will be comparatively less. and the cost will also be reduced. Industry examples are these are the examples of the industry of data mining from retail to healthcare. Okay, let's see this. So text mining, also known as text data mining. The what we do in data mining, just same thing we have to do in text mining. Clear? Converting unstructured text into a structured format. The structured data, a proper standardized data which will consist all the rows and columns. Okay, proper input will be described over here. Unstructured data means some data is here, some data is here, some data is here, not in a proper format, not in a proper, you can say, in a proper structure. Some data may be in the format of image, some data may be in the format of audio, in the text. So you need to make the data, you can say a unified version. And semi-structured data, that is files written in XML, HTML are included in the semi-structured hypertext markup language. So this is basically used for designing the web pages. Now, mining techniques are information can be retrieved. Okay, following are some examples of typical IR side jobs, that is tokenization. It refers to the process of separating a lengthy piece of text into proper sentences, one sentence, two sentence, three sentence. Stemming means a large type of lengthy text is given to you. You have to frame those texts into a proper short statements in a brief statements. Stemming is to remove all the prefix like Mr., Shri, okay, then G. So all these things should be removed, the prefix and suffix from the word in order to make it more clear. Now, what is natural language processing? That is NLP. Again, it is a type of AI that allows computer to understand the text, to understand the process, the video format, in the audio format, and also manipulate human language. How it works? It uses machine learning, different statistical methods and models, text mining to analyze what human mind is thinking, what human language is. They will interpret that, what natural language processing. So what it can do? It can perform variety of tasks. It can understand the text. Okay, then categorize in a similar nature of text. Generating, they will generate a response. What human will give response? So they will generate the same response. Translate them. Translate between human languages. Human means suppose if we can understand Hindi, so they will translate in Hindi. We can understand English, so they will translate in English. And it also recognizes the pattern. The same pattern is following or not. So AI understands the pattern, the coding. The same pattern has been defined or not. If there is a same pattern, they will group into the same category. The another same kind of pattern will be grouped under the same category. So this is how they work. Tell me, any doubt, anyone? Now, typical, there are some examples of NLP: summarization, tagging, text categorization, and sentiment analysis. Just a minute. I okay. And how information can be extracted? We need to select proper information. Okay, then only we can extract from that. and the name should be defined properly. The entity, the enterprise name, the entity name should be defined. The recognition should be made so that this AI can define the name and entity well. Data aggregation means what? Aggregation means the collection of what? The raw data, and presenting it in a summary format. Okay, this we have done. It is included into time aggregation also and spatial aggregation also. Tell me, any doubt to anyone? And this, okay, these are the 6 points. You should learn it properly. What are the industry examples of data mining? The first is retail, second is financial services, insurance, manufacturing, entertainment, and healthcare. Okay. And there was one word called spatial aggregation. Okay, see, aggregation is what we need to collect whatever time is required for making a particular information, for collecting information, for storing them, okay, for disseminating them. So the time should properly be mentioned over here. And what is spatial? That is the, you can say, the collection of all the data, okay, related to the geographical area. Related to the geographical area in order to protect all the you can say, in order to protect all the, you can say, personal information of all the customers, of all the users, so that their data may be protected. Okay, nobody can uh, take the benefit of those data. Clear? Chalo. So this we have done. Forecasting means what? For making predictions for the future. Okay, what has happened till now and what will happen in future. We need to do this forecasting method with the help of qualitative and quantitative techniques. Okay, there are short term forecasting also, medium term forecasting also, and long term forecasting also, that ranges from 15 years till 10 to 15 years. This is 1 to 5, 5 to 10, and 10 to 15 years. So what are the features? It helps to determine all the future events. Okay, it covers the recent and historical occurrences. From history only, we will learn in our present time. Okay, and we will apply the same thing so that nothing, whatever happened in the past. Okay, we need to rectify that with the help of analysis of the past trend. Uses of various techniques of forecasting. Now, data visualization. So representing data in the form of chart, plots, diagrammatical representation is what? Data visualization. Like in histogram, okay, like scatter plots like this, heat maps, tree maps is like this, the decision tree. You have seen yesterday, decision tree. So this is what those are also a type of, you can say, data visualization. Okay. The tables, this is a grid with rows and column like this. Pie chart you have seen like this. Lines and area chart comes lines. Here, now, what is big data analytics? Big data analytics, see, from the name, you will see it is a very big, means it is a very, you can say, a advanced version. Big data analytics is the application of more advanced analytics method to very large diverse data sets. So we have a lot of data, we have a lot of data sets. Okay, so now we need a big data analytics so that we can have a more advanced analytical methods to all these data sets. So they may be organized, they may be semi-organized, semi-structured. Big data is a term that refers to data sets that are so large or complex that typical relational databases are unable to effectively record them. So for this, we need a big thing for that. So what are the uses? It enhances the integration of customers because all the data related to everyone, the related to customers, clients, okay, we need to gather that so that they can also motivate, okay. Detecting any kind of fraud in the company, providing efficiency. So again, in these six industries, the big data analytics is used. So in the manufacturing also, for maintenance, for operations, for optimization, it is used. Then in retail sector, it is an industry with lots of strong competition. Competition is very large in retail sector because the customers will go to the retail sector only first. Then they will go to the wholesale sector. So product development, experience, the value, the worth, everything is included under this retail. Healthcare also we need big data analytics for finding any kind of fraud, okay, happening in the medical care center, healthcare, patient experience. For oil and gas, oil exploration and discovery and optimization. Telecommunication, because many data theft occurs in this category only. So we need to optimize more network capacity. Okay, we should assure that the data should be more protective. Telecom, customer, new product offering. In financial services, fraud, innovation for anti-money laundering, that is converting what a white money into a black money, that is anti-money laundering, and any kind of compliances which the financial regulatory does not follow, we need big data analytics there as well. What is the importance of big data analytics? It helps in making a proper decision. Okay. It enhances the customer experiences also because data is necessary for the customers as well as for the organization. It increases efficiency. It helps to minimize risk. Competitive advantage. We know our customers, so we can move one step ahead from our competitors. So this is only possible with the help of, if we have a large amount of data, if we have a huge data sets, then only this can be possible. We can be stay ahead of competitors. That is, we have a competitive advantage. Healthcare, strategic management, social and economic development. So these are the field. Enhanced security where we need big data. So how does it work? First, we have to collect the data. Then after collecting, we need to process the data. We need to check, is that data giving us a good result? Is that data does not make any kind of fraud, any kind of scam? Okay. Then data cleaning, because a lot of data it will provide. So now we need to do the mining of the data. And finally, we will analyze the data. Okay, I required only these data for my organization. So is it possible that these data will help me to forecast for the future event, for predict for the future event? Okay, clear this big data analytics. Hmm. Now, how- open source system. Open source system or software. Open source system or software that is developed and maintained through collaboration with the, you can say, consolidation with the teamwork. It is available for anyone to use. Anyone can use it. Okay. Anyone can modify it. It is free to use and it may be redistributed. Means it is open for everyone. like Android, Java. Okay, then you have heard this Ubuntu. So these are what open source software, anybody can use them. Now, what is the process of business analytics? First, data mining. You will collect the required number of data. You will do the forecasting. You will do the prediction, predictive analytics, and then finally uh, you will plot your data in the form of charts, in the form of diagrams, in the form of, okay, in the form of all these categories. You will plot your final data. So, what is the business analytics skills? There should be critical thinking. Working with business analytics requires not only recognizing which data can be useful in decision making, but it also requires not only recognizing which data is useful, but it also recognizes to solve all the problems related to that data. So ability to solve problems, then communication. You are very curious for that. Okay, how things will work. You have taken the data, how that data will plot on that particular chart, okay, how the development will be done. So anxiousness or curiosity will be there. Then attention to detail, because those who work in the industry deal with such huge number of data, it is very difficult for them to you can say to take the correct data, okay, to pick up the correct data. So we need to be very attentive for the data which we are picking up. Tell me, any doubt, anyone? We have completed our unit number 23. Hmm. Should I move forward now? We have to start with green and sustainable financing. So what is green financing? It refers to the financing that helps and support the environmental projects. Okay, we will only invest in such kind of project which will help our environment. Okay, it will be eco-friendly. It will be environmental friendly. Like for example, there's a project on saving water. Okay, okay, we are making different types of, you can say, a prototype where water can be saved. Okay, only few nobody can waste the water. So if anybody is investing in on such kind of project, then that means they are investing on a sustainable, that they are doing sustainable financing. Sustainable financing. Okay. So this can influence funding for renewable energy, for energy efficiency, for sustainable agriculture, okay, reduction of harmful gases, reduction of carbon emissions, okay, reduction of ozone depletion, and making our environment more green free. So there are some ISO, okay, these are the standards set by the international organization standard that provide the guidelines and frameworks for maintaining, managing the ESG. What is ESG? That is, E stands for environmental, S stands for the environment. We should protect the environment. Everything should be environmental friendly. It should be social, means we should work for the welfare of the society and for the government as well, as that is governance. Okay, so these standards help to ensure the transparency, accountability, and all the practices for efforts. So these are ISO. Very important. You need to learn the codes: 32210 framework for finance, 14007 cost and benefit, 008 for environmental impact, and 14,097 that is climate change. Okay, you have to cram all these things. 14,000, it provides guidance and identifying and assessing environmental aspects. What are the instruments that to fund green financial project? Green loans, green bonds, equity, risk mitigation products. So these are the four categories where we can fund our green financial projects. Green bonds, they are also a fixed income instrument to raise funds, and they will also work for the positivity of the environment. So these are debt securities, okay, where we invest for different projects for regarding renewable energy, sustainable agriculture. So these are related to eco-friendly projects. Every project under the sustainable financing will relate to eco-friendly. What is greenwashing? Greenwashing is a tactic many company uses so that their product may appear more green. Means they are showing that they are using everything organic. The whatever ingredients they are using, it is organic. It is you can say environmental friendly, so that the normal people, the public, the customer, the consumer may purchase it, and they will also feel that okay, we are working anything, we are working good for our organization. So it is just a tactic. Okay, so for this, we need to stop this greenwashing. Okay, if originally we want to do anything good for the organization, so first of all, we should not give false impression on that. Okay, the false truth is, you can say, we should not give them anything false, anything bad impact that will create bad impact in our organization, because it seems effective, but in original it is not. This tactic is distracting from the actual sustainability efforts. Means the one, if one person, one company, if he or she does the work in a proper manner for eco-friendly products they are being launching, so it will also give them a, you can say, everybody will feel that, everybody will think that okay, the whole country is a false. Okay, they are showcasing their you can say the products in a very bad manner. Okay, they are giving a negative impact to our society. So the original person who are doing in this work, they will also feel that they are also giving the false impression. Now, what are the benefits of green investment? Additional source of financing they provide for environmental friendly projects. They also help for the reputation of the company so that it can become more transparent. Okay, cost advantage is there. Facilitating greening from brown sectors. Okay, working for the more and more green environment, and making newly developed environmental friendly financial products that will help to our organization for betterment. Now, public policy in India. So, Reserve Bank of India issued a notification in December 2007 titled what? CSR. See, we are taking the raw material, the resources from the economy, from the society. So, it's our responsibility to return anything good to the society. So, in what way we can do this? From CSR, that is corporate social responsibility. It means whatever you are earning, you need to pay to the society back. Okay, the average net profit of 3 years. Yes, and since 2012, the significant strategic step has been introduced for sustainability disclosure. We need to focus more on more CSR to fulfill it. And in 15, it expanded priority segment lending program. This program is mainly for the renewable projects, renewable energy projects. Means those energy which can be renewed. Then Reserve Bank, they also work for under group of 20 countries, okay, for financing study group in its annual report 1516. They also highlighted climate change possessed to assets in its report. So, what the changes which can happen in the financial assets in the climate with the help of with this financial assets, what the changes which are happening in the climate. So, for this, they have provided the report on trend progress of banking in India in the year 2018 2019. Progress of green finance, improvement in general awareness, green lending, and green bonds. What are the guidelines of the SEBI on the issue of such green bonds, that is, green or green securities? Renewable and sustainable energy, they should include wind sector, solar sector. Clean transportation should be used so that public transportation will can maybe clean. Okay, everybody can use this. Water management, adaptation, and energy efficient. Then sustainable waste management to recycle, reuse, and also work for so that these goals can be achieved by 2030. That is sustainable development goals. Conservation, biodiversity conservation, and land afforestation means planting more and more trees. Where need out to anyone, now what are the disclosure requirements from the SEBI, that is a statement on environmental objectives, green securities, debt. Okay, brief details should be there before disclosing, or means you should provide all the details of your project, the which the issuer has followed, details of the system, details of the project or areas where the issuer is you can say proposes to utilize the proceeds, the revenue where he or she wants to invest. If any third party is there, any independent third party, we need to disclose that also. We need to clarify for what purpose this third party has been in this particular project. Then national determined contribution submitted by India after Paris Agreement. So as the climate is changing, so all the things have been discussed under COP21, that is Conference of Party, which was held in the year 2015. Okay, and it was held in December. See what is important in this. First, the formula is important. Clear. Next, for climate change, which type of meeting was conducted? The Conference of Parties, COP, and it was the 21st party. It was. This was conducted. It is held in Paris and it was conducted in the year 2015. How many governments were included in COP meeting? Nearly 200 governments agreed to make this country more strengthened in terms of climate change. And what was the, you can say, what was the factor on which they have agreed? That is holding the increase in the global average temperature to well below 2% degree. Means below 2% degree, we need to keep the temperature, we need to keep the carbon emissions in the pre-industrial levels, above pre-industrial levels. Clear? So this 2 degree Celsius, 200 degrees Celsius, 200 government, which when it was conducted in December 2015 and the place was Paris. And in which meeting it was said all these things? The COP21, National Determined Contribution. It was submitted by the agreement when the agreement was made between India and Paris. Now, the eight key parameters highlighted in nationally determined contribution, the lifestyle, economic development. We should reduce the emission, okay, and GDP should be maintained properly. Non-fossil fuel based electricity, enhance the forest carbon sink. Climate is changing, so we need to adapt to that because if we are not working for the ozone layer, so we need to adapt the climate change. Mobilize finance, whatever finance we have, whatever we have, government has funded in regard to sustainable development. So it needs to mobilize, it needs to, you can say, uh, scattered, okay, distributed. And different technologies are in, there's enhancement of technology every day in the country. So with the help of technology, can we prevent carbon emission, can we prevent ozone depletion? So we need to do that, and if required we can also transfer to many other countries, many other states, okay. So what are the prudential risk for bank? In April 2020, the Basel committee, they published a report, okay, on climate related financial risk. So, what was that in May 2020? The central bank, for greening the financial system, okay, they published a report so that the supervisors may guide them what mishappenings are happening in the climate change. We need to supervise it. Okay, climate are changing. There are eight, you can say, not eight, there are certain parameters on which we have to work so that we can combat the change which is happening to our climate, and that change is, if that change is a negative, then we need to combat. If that change is positive, we can go for it. RBI views on climate risk is what? RBI joined central bank supervisors for NGFS. They also represented group of 20 sustainable finance work group. In again May 21, RBI set up SFGs for Sustainable Finance Group. The Sustainable Finance Group in the Department of Regulation, they carried a survey in January 2020 to find the what is the status of the climate, the risk of the risk which is happening in our climate. Again, there are three types of risk: physical, transition, and liability risk. Tell me, any doubt to anyone? Any doubt? So basically, these physical risks are what? The climate change risk, okay? Like you can say the flood, the drought, okay, weather patterns. These are what? These comes under physical risk. Transition risk are what? The risk related to, you can say, related to natural resources, okay? The market fluctuations. So these are what? These are type of transition risk. And you know what is liability risk? Okay, any doubt to anyone till now? Can we move forward? Now only one chapter is being left to complete, and that is SPAC. Very interesting chapter. I'm giving you 1 minute. If you have any doubt, any of the previous topic, you can ask me, or else I will start this session. Sorry, this unit. Chalo, I think nobody's having any doubt. Now, what is SPAC? See, suppose this is my company. I'm the owner of this company. Okay, I want to acquire this company. This company is what for me it becomes a target company. Here, but I have a lot of work to do. I cannot invest more time on acquiring this target company because it takes a lot of time, a lot of energy, a lot of effort. So for acquiring this target company, I have, you can say, I have made one new company. I have formed one new company. Suppose this company is A, this is B, and it is named as C. So this company is being formed, and this company is said to be a SPAC, Special Purpose Acquisition Company. Now, the investors, okay, who want to invest in my company, okay, so these investors, what they will see that I am being acquiring another target company. So I have told them that whatever money, okay, you give those money to SPAC. Okay, these SPAC will do their job. These SPAC will find the target company. They will acquire this target company, and they will, you can say, they will transfer all the shares, all the assets, all of the liabilities to my company. So for specific purpose, these companies has been formed. And this company, the name of this company is Special Purpose. That is why it is named as Special Purpose Acquisition Company. So SPAC is publicly traded shell corporation, and they raise capital. These investors raise capital what through IPO, initial public offer. They raise capital through an initial public offer for the purpose of what acquiring or merging with an existing private company. So basically, this SPAC, what they do, they acquire, they raise through IPO. So this typically takes 18 to 24 months. Okay, if this happens within 24 months, that is within 2 years, then all good. If it does not happen, then these company have to return the money to the investors. Now they have to refund the money to the investors. The investors have invested money in this company. Now, if the acquisition is not done within 2 years, then the SPAC companies has to return the money to the investors. So this is how they perform. And once if the acquisition has done within 2 years, then the SPAC company, the work of this company has been done. So now they will be de-SPAC. They will be liquidated. So this is how they work. This is how they perform. The whole stack is dependent on this particular diagrammatical representation which I have explained you. Clear? Tell me clear. Now let's have a thorough reading. Okay. So if SPAC does not complete an acquisition within that period, okay, it is required to return the funds raised to investor. The funds which investors has raised to their company, now it's their duty to refund those money back to the money to the investors. Why? Because the work has not been completed. So why they will going to keep the money? These investors will invest in any other company. Now advantages and disadvantages, it is a speedier execution. Okay, discovery will be there of the price, raising additional capital, reduce market cost, and there's ease of access of specialized or operational knowledge. So these pack when they have been formed, so they have a very much experience. Okay, so the members who are under this pack, so they should be a experience holder. Here, not that anybody can come and form this company. No. And what are the disadvantages? Inability to use, to track use means if they could not track the proper target company, then the reputation of this company will go down. These companies, they do not earn a huge profit. So there are poor returns. They have a low market capitalization. Okay, increased regulatory oversight. Shareholding dilution is also there. Deficiency in available capital, due diligence. So these are the few disadvantages of SPAC. And if they do not work, if for what purpose they have been formed, if they have not completed that purpose, then definitely the money which the time, the money, effort, everything will be wasted. So SPAC formation timeline is how much? Again, creation of SPAC, filing the you can say the exchange commission. Okay, 1 to 3 months. In within 1 to 3 months, it will be get ready for the IPO. Then another 3 to 18 months, the SPAC will find its target market, the acquisition search. If it has been done, then the announcement will be done from. It will take 6 to 24 months for the announcement of the acquisition. Okay, and then at last within 2 years, 12 to 24 months, okay, it will take to close the transaction. So this is the minimal month and this is the maximum month. So this is the minimum, this is the maximum. Clear? So within 2 years time period have been given to them. Now, so this is the formation or and IPO phase. Okay, 8 plus weeks. Then up to 19 months, the target search will be there. The target company, the SPAC will search the target company. The meeting will be conducted. Then negotiation will be done. Okay, proper on the price. Then if everything is approved, everything goes well, then they can approve. They can say that okay, I have a target company. Now I want to do the acquisition. They will announce this up to 5 months. So between this, it will take 19 months, and till here it will take 5 months. And then once the merger has been done, they will close the merger. They will do D-SPAC, and they will wind up the company and return the investment to shareholders. Here, so approximately this will take 12 to 24 months to complete the whole process of SPAC. When SPAC finds its target market, its target company, then the process is done in agreement, in meetings, in overlapping, in negotiation. Then means the start is clear to you. Okay. Now, so what are the process? The parent company is there. Okay. From the IPO, these investors will provide fund to the SPAC companies, and the SPAC company, they will look for the target company. Once they have acquired this target company, they will transfer the ownership to the parent company. Clear? And the funds which they have, the investors, they have provided the funds to the SPAC company. So this parent company, what they will do? They will raise the shares. Uh, these investors, okay, they are investing in such companies. In return, they will get a huge amount of profit. Okay, so this is how they work. Now, what is trust account? It is a special type of account where money is kept by someone, and that party is the trustee for the benefit of another person. Means, suppose I am a trustee and beneficiaries. Means, for this person money, I am keeping it safe in the bank. So whose money I'm keeping it safe? The person is called beneficiaries. And the money which I am keeping, the money is kept by someone, means by me. So I am trustee in this case. And where I will be keeping this money in the trust account of the bank. Here. So trustees is responsible for managing the money. So I will be responsible for managing this money. If any mishappening occurs, so I'll be liable for that according to the specific rules. In a SPAC, this account holds the money raised during its IPO. So this in IPO, till IPO, I will hold this money. Here, now what is the D-SPAC process? Again, D-SPAC or D-SPAC transaction refers to the process of merging SPAC company with a private company. Okay, so the following procedures make up each stage of the D-SPAC. Just a minute. I guess I have written something wrong. Just let me check something. Okay. So what is D-SPAC? Yes, this D-SPAC companies, they merge with uh you can say a SPAC company. Okay. And it refers to the process of merging a SPAC with any kind of any private company. Means this SPAC company they merge with private company to form to take the ownership control, okay, of the public company. Means effectively they are taking that private company as a public company. So this is de-SPAC. So they merges with public company so that they can take the shares of the private company. They can do proper acquisition. So requirements needed for shareholders approval. Okay, then proper voting rights should be given. Okay, founder should approve for the voting rights. Then if everything is fine, everything is fine. It needs to disclose all of the materials. Okay, you should disclose every material, every fact related to this on this Super 8K form. After that, you can redeem your offer. Means uh, you can redeem the offer back. Redemption is done. Everything is fine, then you can wind up the companies. You can liquidate the company. Where see what happens in de-SPAC process once all the transaction has been done. Okay, once the merger has been done. So what this de-SPAC can do? Okay, these the shareholders can vote and they can also redeem their shares back. Means this is the last step which they have been provided to follow all these things. Now it is clear to you all. So basically, these are desirable because they give owners of, you can say, a public shares the option to exchange their shares whenever required. Okay, so this is the aspect of redemption offer, and this redemption offer will not be valid for the public warrants. These are only valid for the de-SPAC companies. Then the SPAC is completed. Okay. And what basic things you need to keep in mind is that this 18 to 24 months, this is very important. In the question, it will be given within 1 year. So this thing you need to keep in mind. Clear? So no, within 2 years the time period is given, and within 2 years, if you are not able to acquire any target company, the you need to return, you need to refund back, refund the investors money. You need to refund the money to the investors. Need to refund. Yeah. Okay. Now, so we have completed all the modules. Yesterday we did module A and B. Today we have completed module C and D. So I hope everything is clear to you all. If any doubt are coming, then please ask, because tomorrow is your exam. And please do share your analysis. Okay, what type of questions came. So if you are not in the Telegram group, just add in that Telegram group. I have already shared. So tell me your tomorrow's what paper came. Okay, what type of questions were asked. I'm waiting for 1 minute. If you have any doubt, you can ask me, or else I will end the session. Okay. So I guess everything is clear to you all. So yes, tomorrow is your exam. All the best to everyone. Okay, do well. Don't get panicked if any question confuses you. Okay, don't stay on that question for more time. Okay, just skip that question for some time. Do another attempt, another question, and if you have the time, okay, then again come back to that question. Which confusion is which question is giving you a confusion? Okay, then whatever you feel the answer is, just do the guesswork over there. Okay, but don't waste more time on any particular question. So, yes, I wish you all the best. Okay. I hope you have enjoyed the session. Everything is clear. We have done many MCQs. We have done questions also. We have done practical problems also. So, don't worry, paper. You only need to get 50% marks. Okay. You don't have to get the AIR. So, just keep in mind that you have to qualify the exam. And if you have studied well, definitely exam will also be go well. Okay, so just have faith in yourself that whatever you have studied, okay, that is sufficient for you. So I wish you all the best again, all the best to all the bankers, those who are having their exams tomorrow. And please tell me how was your paper? Okay, I'll be waiting for that. So good night, everyone. All the best. Take a good sleep. Okay, and believe in yourself. Ki whatever you have studied, definitely those questions will only come. Help. Take good care of yourselves. Keep studying, keep watching, and keep take good sleep, because tomorrow is our exam, so you need to take a good sleep as well. Well, we'll meet you tomorrow. Bye bye. Take care and good night. And all the best once again.